Standing Committee on Tax and Revenue, the inquiry into housing affordability and supply in Australia. In accordance with the committee's resolution of 25th of July 2019, the audio of this hearing will be broadcast on the Parliament's website, and the proof and official transcripts of the proceedings will be published on the Parliament's website. I now welcome the following witnesses from the National Housing Finance and Investment Corporation, Mr Nathan Dalbon, Mr Hugh Hartigan and Mr David Crawford. For the Hansard record, would each of you please state your name and the capacity in which you appear before the committee?
Thank you, Chair. Nathan Dalbon, Chief Executive Officer.
Hugh Hartigan, Senior Advisor, Jason, and David's an apology today, Chair.
Thank you. So Mr Crawford's not joining us?
Correct.
Well, he'll get a naughty slip then and be sent to after school. Anyway, this hearing is a legal proceeding of the Parliament. The giving of false or misleading evidence is a serious matter and may be regarded as a contempt of Parliament. The evidence given today will be recorded by Hansard and attracts parliamentary privilege. It is important to note that although your evidence is protected by parliamentary privilege, this protection cannot be enforced outside Australia. I now invite you to make an opening statement before we proceed to discussion.
Thank
Mr.
you.
Dalbon, will that be? Thank you, Mr. Dalbon.
Thank you. Thanks very much for the opportunity to participate in the hearings. As part of the opening statement, I want to give the committee a very brief overview of NIFIC's purpose and our role in supporting housing outcomes across the housing continuum. Second, a brief rundown of NIFIC's research reports released over the last 12 months, which includes the developer contributions paper we submitted to the inquiry. Our second, State of the Nation's housing report, which will be released in December. First, who we are and what we do in terms of NIFIC. We were established by the government in 2018. Our mission is to improve housing outcomes for Australians. To that end, we administer a range of programs that help improve housing outcomes across the housing continuum. They include the Bond Aggregator, which harnesses institutional finance to support social and affordable housing projects to support the growth of the community housing sector. The National Housing Infrastructure Facility, which funds critical infrastructure to unlock new housing supply. A range of schemes to support first home buyers, including the First Home Loan Deposit Scheme, the New Home Guarantee and the Family Home Guarantee. And a research function which undertakes research into housing demand, supply and affordability across the housing continuum. Given the focus of this inquiry, I thought I'd just briefly expand on NIFIC's research. Our research agenda is informed by extensive consultation with stakeholders across the property, finance, academic and government sectors to ensure it remains relevant and also accessible to a wide audience. Since commencing 1st of January 2020, NIFIC has produced 9 research papers, including our first flagship State of the Nation's housing report last December. Over 2021, we've released 4 short research papers, including a paper looking at First Home Loan Deposit Scheme trends and insights, a paper looking at developer contributions, which has been submitted to this inquiry, a third paper looking at stamp duty reform, a fourth paper looking at different financial structuring options to support subsidised housing. Just very quickly on this year's upcoming State of the Nation's housing report, our second flagship is due by mid-December this year. The report provides long-term projections of new supply and new household formation, which is one indicator of housing demand, which provides a long-term snapshot of the balance of new housing supply and new households. After extensive consultations and roundtables with industry, peak bodies, developers and other stakeholders, we're building on and enhancing our report for this year, including moving to 10-year projections, which better aligns our projections with the housing development cycle, expanding on the distinction between new household formation, which has been weak due to low population growth driven by a pause of net overseas migration, and what we're seeing in terms of strong house price growth, which has been supported by factors such as low interest rates and fiscal stimulus measures. Thirdly, enhancing our affordability analysis. Our Lorenz curve work, which shows the distribution of income versus property prices, will show the distribution of affordability across major cities and regional areas. And lastly, we'll include a regional focus to reflect the changing internal migration patterns following COVID. Like our first report, we're relying on the Centre for Population Numbers to help inform our views about future household formation. I hope this gives the committee a snapshot of our work and we're happy to answer any questions.
Thank you very much, Mr. Dalpole. So, ladies and gentlemen, we have these witnesses until 9:50. That's roughly 40 minutes. I understand Ms. Jed Carney is on the phone. Jed, you can hear us? Can you say hello and see if we can hear you? No,
Hello, can you hear me?
We can hear you now.
Hello,
All right.
can you hear me?
Yes, we can. Can
Great.
you hear us? Okay, great. So that means we have 6 members, making my maths really, really difficult, but I'm going to say that's roughly 6 minutes each with about, let's call it 7 minutes each. So I'll go myself, then the deputy chair, then then Gladys, then Jed, then Matt, then James. Mr. Dalpole, in the report that you provided to us, you indicate that significant upward pressure on price is being caused by lack of supply. Is it possible for you to elaborate on how you see reforms on developer contribution taxes alleviating some of these supply issues?
Mr. Hartigan, do you want to take that question?
Yeah, I can take that, Chair. So I think there's a couple of ways to kind of think about developer contributions. I think one of the key criticisms of contributions, look, we consulted really widely with developers and local governments and state governments. And I think the key criticism coming through of developer contributions, particularly for sort of the builders and the developers out there, was the variability and unpredictability of these contributions. So for instance, if a developer's out there, gets some kind of zoned land it wants to build on, throughout the development process to when it gets stocked to market, developer contributions, the nature and the scope of them can kind of change all the way through there. So what that actually does is it actually sort of heightens the risk, of the project. And also I think the other thing, so obviously if you raise the risk of a project, it raises the cost, and that's obviously going to, affect supply sort of over the long run as well. I think the other key thing that we drew out in our paper was...
Mr. Hartigan, do you mind if I interrupt you with a bit?
Of course.
When you say risk impacts supply, does it impact supply in the sense that people just abandon the project so it never happens, or they have to charge a lot more money to take account of that risk?
It's a feasibility thing, right? So, I mean, if you're a developer and you're kind of looking at a project to build, and you're sitting there at the beginning and saying, well, we're not really sure how much developer contribution we're going to have to pay. So ultimately, we're just going to have to factor that into our feasibility, right? So, it might be 50,000, but you never know, it might be 100,000. So ultimately, what that means is that's an additional cost. I think the other thing in our paper that we sort of go to...
That 50 or 100, that's per block. So if you're developing 300 houses, it's the difference between, what is that? 1.5 million versus $3 million. Is that right?
Yeah, exactly. Exactly. So it's per lot. So it's quite substantial. And I think in our report, we sort of drew out that, they can be as high as $90,000, particularly in places like Sydney. So, depending on the cost of the actual project, that could be anywhere from 10, 12, 13% of the cost, right? And so we might talk a bit more.
And do you think it's a coincidence that the epicenter of this affordability crisis is New South Wales, and that also happens to be the place with the highest developer charges and contribution charges?
It's difficult. It's difficult. Look, I mean, I think this goes to a broader point, Chair, if I may, which is around transparency. I think one of the key things that we kind of made, clear in our report is there's a fundamental lack of transparency in this space. So it's really difficult to get good aggregated data comparing state by state. So we sourced, to the best of our ability, some really good case studies, which is where we came up with, a few good case studies from Sydney that sort of had an average of about sort of 80 or so thousand. Now, that might not be, that's a pretty small sample, but it sort of goes to the point with some of these things. If you don't have transparency, we don't actually know, across the sort of housing spectrum across, say, a place like Sydney, what the average developer contribution charge actually is.
And these charges have been levied by local and state governments.
Correct.
And they're responsible for reporting what those charges are.
Yeah, so there are, in a disaggregated sense, I mean, local governments, to be fair, some of them have pretty good reporting, that they do put out developer contribution statements that you can go and kind of weed through on their websites. But there's a bit of a lack of consistency in terms of the way they're reported on websites. And the point is, it's very, very difficult to get good aggregated and consistent data. And I think that's the sort of point we were making.
So I'm concluding out of this that we have two levels of government that not only are making outrageous charges, my words, not yours, on builders who are trying to supply housing, but they're also hiding what those charges are so that it's not transparent both to the public and to other people.
Oh, I mean, look, Chair, I would make the point, and again, this came through in our paper too. Look, there's a fundamental problem with, we have to fund infrastructure and local infrastructure that goes around housing developments. We all want good parks and amenity. We all want good local roads. That has to be funded somehow. And I think that developer contributions is seen as a kind of new way to do that. I think one of the things that we point out in our paper is, depending on the scope of developer contributions, if there's a really strong nexus to the development, then, developer contributions might be, entirely appropriate. If the scope is much wider and is kind of helping to fund broader community infrastructure like recreation centres and pools, then it may well be that rates are a more appropriate way of kind of funding these things, and they're more transparent.
But one of the issues that you allude to in your paper is also that a lot of these charges, which are supposedly for infrastructure, are in fact getting spent on other things, and you can't see that they're actually being helped there.
Yeah, I mean, look,
that they're creating infrastructure.
Yeah, I mean, look, we went on this sort of journey on this project, very sort of, with a very balanced eye. I mean, the thing that I was a bit surprised about, I didn't know that they were being used at the state level to help fund schools and hospitals, for instance. And these are things traditionally sort of funded by general revenue and state budgets. But there's clearly been an appetite and I suppose more of a preference to fund some of this broader infrastructure through developer contributions. Whether or not
this sort of behaviour by state and local government has had an impact on reducing supply. Has the situation got better or worse over the last 50 years, 20 years, 10 years?
Oh, look, Chair, it's very difficult to tell. I think the one thing we would say is that, the use of these things has been growing, certainly over recent decades. I mean, a lot of local infrastructure used to be delivered from, directly from state budgets, which was, I suppose, directly from the general taxpayer, across the state. Whereas there's definitely been an urge and a preference to use these to sort of fund that, local infrastructure.
Well, Mr. Hartigan, it might actually even be worse than that, because my reading, we had a whole bunch of community housing providers such as National Shelter, who is the Peak Group, and they asserted that the federal government has always funded social housing, which maybe go back and look at the research papers that they sent through. And what is quite clear is that in the 50s, 60s and 70s, the federal government actually directly funded infrastructure that then allowed for the rezoning and for houses to be built. What appears to have happened over time is that we've now more directly funded social housing or public housing in that time period. And at the same time, the state and local governments, instead of continuing to fund that infrastructure, have shifted that onto builders. So there is this transfer happening, once again, where people are not getting the same value for money as more responsibility for financing it has fallen on the Commonwealth Government.
Yeah. I mean, look, and I think the broader thing to keep in mind is, look, a lot of the people we consulted with weren't vehemently opposed to the idea of developer contributions, even some developers themselves. But I think that the implementation in terms of efficiency, administrative simplicity and those things, and the scope, there were very, very big sort of disagreements and, oppositions, I suppose, to the sort of magnitude, scope and the way they're currently being implemented, and transparency.
So two last questions. So this has clearly reduced supply. Has it also slowed down the capacity for builders to respond when there's a surge in demand?
Look, there are some studies that would show that, if you're raising the risk profile of projects, particularly if you go to that sort of variability and unpredictability point, that I mentioned, certainly that's probably going to affect your small to medium-sized builders more, and it's probably going to affect your competition in the market, which could go to cost, yes.
And what is, and you may want to anonymise it, but what is the worst instance you've seen of this?
Oh, you mean in terms of magnitude or process or?
Magnitude and process, yes.
Well, look, I think the case studies we sourced in our paper, I think there's sort of 80, 90,000. I mean, they're pretty high in terms of relative cost. I suspect there are some a bit higher, but I come back to my original point. It's very difficult to get really good, aggregated information on these things.
And in terms of process slowing people's applications being approved, what's the
Yeah,
worst that we've seen?
We got given a lot of sort of, I suppose, anecdotal things about, when we went out and spoke to developers. So it was a lot about, I'll give you one other example, which I think really goes to the idea of how you can get a lot of unintended consequences with these policies. And I think that was another key point we made. A lot of these policies might be well-intentioned, but there is a high degree of potential for unintended consequences. A lot of projects, we were told, are now requiring a lot more open space. Now, there's nothing wrong with that. People love open space, it contributes to good amenity, etc. But if that keeps getting bigger, that requirement, that's ultimately going to feed through to worsening feasibility and more and less housing supply.
Sounds like we've given local government too much power. My time is up. I'm going to hand over to Julie, but before I do so, can I just ask everyone who is not speaking, therefore not the witnesses, to ensure that they're on mute? Thank you. Julie.
Hi. Thank you for your evidence and your submission. Can I just follow on briefly on that developer contribution side of things? Obviously, if there's bad planning, in the wrong order, someone is going to have a cost that's unexpected, whether it's a council, a developer, or a state government. It seems to me, from what I'm hearing in the evidence, that it's not necessarily the contribution itself which is the problem, it's the order in which everything is done, that land is released when the environmental approvals aren't done, the planning's not done, the builders. So it seems to me that it's an order issue and a consolidation of the planning process that is the answer, not necessarily getting rid of the contributions. What do you say to that?
Yeah, look, Julie, I think that's definitely part of the story. And as I said to you, look, we didn't get, when I went out and spoke to developers and local governments and state governments, there was generally a feeling that these policies can work. It's just that they need to be implemented in a more transparent way to help reduce that unpredictability and variability. The unpredictability and variability along that development process was really the main point that came through a lot of our discussions. Now, things are always going to pop up, along development cycles. There might be sort of an environmental issue that pops up, which may need to get addressed, but certainly the advice to us was that this just happens all the time. And there's a lack of vision of, I suppose, look, some states go out and they cap development contributions. Now, that helps to provide a bit more certainty around sort of the maximum cost, but at the same time, there's problems with that approach as well.
And you'll still get an environmental approval that that suddenly, yeah. So what would the process be to solve this, to break the system apart and put it back together again in a way that would actually work? How would that happen?
Well, look, we go to some of these, there's different kinds of models that we've set out in our paper. And I think the sort of prevailing view is, whether it's a sort of developer-led charge or a local government-related charge, we've got them all set out in our paper, is, trying to get that done sort of earlier on in the process when land is zoned. If you can kind of, come to an agreement around what infrastructure needs to get built, and then you can sort of sign an agreement per se, and then everyone keeps to that. I think that would be a far better approach than the current approach.
Thank you. Can I go to data? Because again, we've heard so many people talk about the lack of data, not knowing when land's going to become available, when it's going to be available for sale, which also affects buyers. Buyers rush in because they don't know what's coming as well. The lack of transparency is a huge problem for everybody. What additional data do you think we need? Because you guys do some great stuff, but if you could do everything you wanted to do, what would it look like?
Look, it's a good question. And I will refer to a project where currently we've helped spearhead recently. You may have heard it from other people showing up to this committee, but we've helped spearhead a project called the National Housing Data Analytics Platform. Mm-hmm. So we've brought together the ABS, who I know are on after us, and various other Commonwealth bodies and state governments and a whole lot of universities. And gone through a prioritisation process up until now. And I think one of the main things coming through at the moment is further back along that sort of development cycle, around even back as far as sort of land. We don't have a lot of good data on sort of land lots, when land lots are being sold, for how much they're being sold, and that's a fundamental input into the project, right? So, I just I mean, that's one thing I think is really important. But look, you've probably heard from many others that, the whole data landscape is very fragmented. And certainly it's our intention to help build a sort of, a more robust sort of housing data asset to try and address some of these issues.
Thank you. And I do have to say, in a recent report that the federal government did, it recommends you reducing some of your data collection and narrowing it down. Do you know what that means, or what that would take away from you, or is there positive in that?
Deputy
I know
Chair,
it's political. Sorry.
yeah, so the report recommends a narrowing of the scope, but on the data side, I think one of the things it suggests is actually doing more in that space. But of course, we need to also see what the government's response is to those recommendations as well.
Okay, but generally, whether it's you guys who do it or someone else does it, there's a far greater need for a national view of data across the nation. Yeah.
Yeah. That's an argument. Can I also just say, Deputy Chair, just jumping back to your early question in terms of, what are the things that could be done to improve the system? I think for me, supply is, to me, a means to an end in terms of, sound housing outcomes, which basically mean people have access to secure housing. So I think there's a whole range of factors that are obviously feeding into that outcome, and certainly supply is one factor. And I think there are a number of things that could be enhanced, I think, to improve that aspect. And certainly from what we've seen, particularly in our dealings with community housing providers, some of the processes involved with getting approvals, timeframes, it seems quite excessive at times. I mean, certainly we recognise that, you have these systems in place for a valid reason. I think that sequencing and the timeframes adds to the complexity and the uncertainty that Mr. Hartigan was referring to.
I think I have 1 more minute. I'll just go. Supply is an issue, but supply of what is always an issue.
Exactly 1 minute, Julie.
Okay, supply of what? So what would be supplied that isn't already supplied if you guys could have your way?
Well, look, I think you have to really break down the housing market, because there's not one housing market. So, at the moment, there's geography matters when you have a look at, say, what's happening, between the capital cities and some of the regions. You'd have to say in the regions, it's a case of, quite a substantial population shift in a short period of time, and it'll take time for supply to respond in those circumstances. If you go to, say, subsidised housing, I think when you look at waiting lists and so forth, there has been a sustained underinvestment in social and affordable housing for quite some time. So the reason why we exist is in part to assist channeling more finance, both from the public and the private sector, into providing more supply.
Thank you very much. Sorry, I'm being cut off. Thank you.
Thank you, Julie. I think we're now, Gladys, you have Bill 31 passed.
All right, thank you, Chair.
It's okay too.
Thank you, Chair. Good morning, Jen. Thank you for your submission. Now, just wanted to ask you this. What does NHFIC see as the key factors influencing housing affordability and supply in Australia?
Mr. Hartigan, do you want to start with that, and I'll jump in?
Yeah, look, it's a complicated question. I mean, I think we've touched on, one thing. I mean, certainly supply is very important for the cost of housing, and I think all other things being equal, if you increase supply, you're certainly going to kind of help put downward sort of pressure on prices and rents. But look, I think we've got to think about the sort of housing system as a very sort of multifaceted kind of beast. And I think that what we're seeing play out at the moment is certainly a whole lot of factors that are sort of driving demand, which is sort of interest rates, etc. And given how long it takes for supply to respond to demand in certain areas, they're all kind of factors kind of contributing to sort of that supply demand mix. I mean, the other thing I'm sure you've heard from others as well is that, look, we'll also become a wealthier country. So more people are willing to spend more on housing, and maybe a larger percentage of their money on housing as well. So, but look, it's a multifaceted sort of response, I'm afraid. Nathan might want to
Look, I think, as Mr. Hartigan said, yeah, there's multiple factors impacting on affordability. There are short-term, long-term, there are structural impacts, and a number of the submissions have pointed to the various factors that are impacting on affordability, particularly over the last 12 months or so, given the strong house price growth in particular that we've seen. But I think another factor for me is also just on the rental side. So when you look at home ownership, there's a couple of indicators there, but also one of the key ones is for first home buyers, for example, in terms of the deposit that's required to get into home ownership. And again, some of the schemes that we administer are attempting to accelerate people's ability to get into their first home. And then I think in the rental market, when you have a look at some of the recent studies, there was a Productivity Commission study, for example, in 2019 that had a look at rentals in the private sector. And one of the factors that was leading to increased rental pressures for low-income households was the fact that the proportion of social housing had declined over time, which was meaning that more people at low incomes were having to rent in the private market. So I think, again, it's you have to sort of break it down into various components to have a look at what are the particular factors that could systematically address each segment. But as Mr. Hartigan said, I think supply is certainly one of those key factors across the board.
Yes, thank you. So have developer contributions become overbearing in some markets and therefore choking a needed supply response?
Yeah, look, it's a good question. I mean, I think from our work, it sort of goes without saying that the larger, developer contributions there's probably more of a potential for an unintended consequence of it affecting supply. But I come back to what I was saying earlier. It's not as simple as saying developer contributions are bad. It's also about, how they're being implemented, by local governments. It's how much, if developers have good vision of how much these developer contributions are going to be and for what's actually going to get built in a timely way for the new home buyers buying homes, then I think that a lot of people would support, a sort of perfect model like that. And the other point I would make, though, is that, look, the larger they are and the more they move away from sort of a strong nexus to the actual housing development, then that sort of it gradually sort of weakens the case for using developer contributions, because there are other sort of charges and taxes that are probably more efficient in funding it.
Such as what sort of taxes are more efficient?
Oh, I think, look, what we sort of mapped out in our paper was that, I mean, I'll talk to an example. I mean, in New South Wales, for example, when we spoke to local governments, they're all very well intentioned, right? They want to build really good local sort of good quality infrastructure in their local areas, but they've been sort of constrained by very stringent rate caps over the last sort of 10, 20 years. Now, ultimately, if they want to go and build that infrastructure, they can't raise enough of that money through their rates because they've been capped. New South Wales government is sort of trying to change that currently, but essentially, and what we pointed out in our paper, is that's pushing more pressure for local governments to actually kind of raise funds through other means. And going to your point, there is less transparency, so I think these are a bit more hidden, which probably tends to kind of reduce the accountability of what's being raised and how they're being used.
Did you want to add anything, Nathan?
No, I think Mr. Hartigan's covered that well. Thank you.
Yeah, but there's no more question from me, Chair. Thanks.
Sorry, thank you, Gladys. Chair, do you have till 9:37?
Okay, thanks. This has been fantastic contribution. Thank you very much, gentlemen. I've learned a lot here and a lot of my questions have been answered. So I really just have one quick question. We heard from a local government, I think it was a regional local government, that they would like to access the fund, NIFIC fund, but because there's a threshold of a project having to be around, what's the threshold at which you can access the fund? 200 million or something? The project?
Sorry, just to clarify, this is for the infrastructure facility, is that right?
Yes, sorry, the infrastructure. Yes. So anyway, she said, I'll tell you the whole point. She said that
Sorry.
if there was a smaller threshold that local governments could access, they would build social housing. But because they can't afford to build massive development projects, they really, they can't actually access that fund. Is that right?
So in terms of the infrastructure facility, there's no threshold as such, that would prevent a local government, I guess, approaching us. And there are some, it's almost like a self-select in terms of some of the sunk costs associated with doing a development and accessing finance. So I'd be happy to look, reach out to a local government and see what the issue is. Typically from an administrative point of view, the projects above $1 million, in terms of infrastructure, would typically justify the cost and expense in terms of going through application and structuring process. But I'd be very happy to reach out to a local government concerned and see if there's something we can do to assist with their particular project. I should also start.
Okay.
Sorry.
Yes, go on.
I was just going to say that.
You say that only because.
Sorry, you go.
You go. All right, I'll go. Okay. She said that she had approached. They were told that there is a resourcing issue for small projects at the organisation at MIFIC, and that they really couldn't resource small projects. That it was actually for you guys. It's funny that you should say that you've got a threshold, I guess, below which it's not viable for you to continue with an application. But if you're saying that you can fund small projects, then that's fine, that's good. That was really my only question.
No problem. Yeah, look, I'd be very happy to talk with local government. We're very keen to do some infrastructure facility projects with local governments. To date, most of our infrastructure facility has focused on state governments and community housing providers. So we think there's a big opportunity. I think one of the observations I'd have is that certainly our dealings with infrastructure facility proponents, and particularly at local government, that initial work that gets done in terms of project viability, which also goes to the capacity and capability, I guess, of some of the project proponents, is something that we're trying to strengthen. And that is by working with other partners that can assist, such as state government authorities, which may also be partnering with local governments. So it's something we're very conscious of, and I'm very happy to reach out to local governments concerned and see what we can do.
Great.
Thank you, Jed, especially for your efficiency. Really appreciate that. James, have you got any questions?
Yeah, thanks, Jason. Could I just unpack a bit further on the infrastructure funding facility that you have a responsibility for? So, how does that work in interacting with state and territory governments? Could you just give an example of, a go-to-woe of how you work with a particular government on a particular infrastructure funding proposal?
Sure. So we have two what we call umbrella facilities with New South Wales government and also the South Australian government, in particular Land and Housing Corporation and the South Australian Housing Trust. And those umbrella facilities, I guess the initial conversations would be along the lines of how the infrastructure facility can help accelerate, in particular at the state government level, particular housing projects. And because, as you can imagine, some of the state budgets are constrained and they have certain timeframes or planning timeframes for which they may be developing future land. So the idea is through the infrastructure facility, which I might add is a combination of concessional loans and also grant funds, that we try and structure, I guess, to a particular project to encourage that bring forward. In other cases, it might be some sort of uplift in the proportion of social and affordable housing, which is associated with the development. So once we establish that there's a need for the state and what are the particular projects, in this case, we've set up an umbrella facility which has a standard set of terms. And then as particular projects come forward, we look at the particulars around a site. There's a key concept called additionality. So we don't want to fund projects which would be funded anyway. So that goes to the bring forward that I mentioned, or the uplift typically in a state government context. And then in the case of New South Wales, there've just been progressive drawdowns as particular sites are being developed. So most of the sites, for example, in the New South Wales project are across Sydney. And as those projects come online, the funding flows.
Thanks for that. And my second and final question is just regarding developer contributions. And I think in your report, you've mentioned the role that they play in other jurisdictions overseas. I think you've singled out the US, UK, and New Zealand. So can you just give us a comment on what your understanding is comparatively of the way or the similarity of what we require when it comes to developer contributions versus what other jurisdictions are doing? Are we in line with those sort of nations? Is it largely the same?
Yeah, look, it is difficult to kind of find detailed information on this, but I think going to your point, like the UK, I think has a sort of system that's, not drastically kind of different to ours. That's my recollection. I don't sort of have it in front of me right now, but I think that it's fair to say that there are other jurisdictions that use developer contributions, but I certainly think, the one thing we've got a pretty good handle on is that they're sort of increasingly being used in Australia. I think the trend has definitely sort of been up over recent decades.
Thank you very much. Matt, you've got till, I can give you to 9:45. I've just got a couple of questions I want to finish off on.
Thanks. Your point about investment in social infrastructure becoming much more prevalent with developer contributions, and I was interested in the table that you outlined with the differences in the various states about what can be funded through developer contributions. Do you think would you support us recommending to the government that they work through COAG to try and get a uniform set of areas that developer contributions could go to? And I'm looking more at the Northern Territory model, where it's funding basically essential infrastructure, roads, drainage, water, sewage, electricity, communications. But it's managed by the states rather than the local governments. So if you've got a greenfield development, the developer would pay into a particular fund, and it would be up to the state to then construct that infrastructure on those essential items. If it was in an infill area, then again, it could only go to upgrading that infrastructure rather than wider expenditure on social infrastructure. Do you think that would be a better model?
I think it's fair to say maybe not for local governments, but look, I think in a broad sense that, the point I'd make is that the Northern Territory sort of scope of developer contributions is certainly more in line with, I think, the way a lot of sort of, industry would like it to be. And the Northern Territory model is probably really, if you look at the things that, that's funding, a lot of developers would see those things as just kind of their sort of normal course of business, right? When they go and kind of, build a housing development, they know they're going to have to kind of, contribute to water connections and electricity and those types of things. And I don't think there's much sort of pushback on that. I think, the other thing I would note is that it's not going to necessarily solve the problem by doing that, because even when local governments are, gathering these kind of developer contributions, projects are still reliant on state governments for, actually coming and building the water infrastructure, for instance, and Sydney Water, it might take a few years to kind of, come and get that done. And certainly I think a lot of the feedback to us has been the timeliness, so that, there's the payment of the developer contribution, but then a really critical factor is the timeliness of when that infrastructure actually gets built. And you can't really have housing kind of being erected until you get these fundamental things done. So, I think a really critical point is this sort of planning and timeliness around when the money's being collected and when the infrastructure is kind of being built is a really critical one. But just coming back to your original point, as I said, I think that would be more of a scope that most people would be very Certainly industry, I think, would be quite favourable too, but also don't sort of underestimate the fact that, you know, sometimes I think there's a bit of a bargain that goes on with developers and local governments as well. So, you know, if a developer goes to a local government and says, we're going to go and build 100 new units, and by the way, you know, we'll also build or we'll help fund a community centre and a local pool, you know, that might sort of help as part of that negotiation in getting supply up. So it's, you know, I'm sort of giving a bit of a long-winded answer, but there's a few things to kind of think about, I think, in that discussion.
But isn't that the point about timeliness? Wouldn't this make the system much more efficient? Because the body that has the responsibility for constructing that infrastructure, namely the state governments, also has the responsibility for collecting the funding. And you could, as I foresee it, build up a fund so that it's in credit moving into the future. So you're reducing some of those timing issues where, you know, the developer's approved to build in an area, they make the contribution, but the infrastructure is not built until way down the track. I could foresee a situation where the infrastructure would be constructed before the developers actually went in there, because you've built up a credit in this fund.
Yep. Look, I think anything that contributes to better timeliness of delivering, particularly it's called trunk infrastructure, you know, that basically enabling infrastructure would be a great move.
On social housing, have you calculated what the deficit of social housing in Australia is in recent times? What do we need to house more Australians that are on waiting lists?
I mean, we haven't done that calculation ourselves, but certainly aware of waiting lists and I guess timeframes that people are on waiting lists.
And do you think we need more social housing, and should the Commonwealth be contributing to funding that social housing?
Look, I think in terms of housing outcomes and the ability to ensure people have adequate housing, I think there are a number of issues that have been looked at, you know, as I said before, in terms of the PC report, in terms of the private sector and some of the pressures that are emerging, particularly low income earners. So I think there are certainly a number of challenges, you know, across the housing continuum, including for low income earners. And then in terms of the Commonwealth, I guess that's always a decision for governments of the day to determine, you know, what their role is. I just note that the Commonwealth, provides, in our case, we have a $3 billion liability cap on the bond aggregator side of things. We also, the Commonwealth, not through us, but also has Commonwealth Rent Assistance, which is providing support to low income earners. So there is a substantial amount of Commonwealth support already on the table. I mean, what the optimal amount is, I guess that's a question for others.
And my final question is, there's obviously chatter in Australia on a regular basis about housing affordability and the Australian market being unaffordable, people being unable to buy housing at record prices. Should we really be surprised by that? Isn't the system designed to produce that outcome in that for investment in property, there are massive tax concessions. There's tax concessions during the life of the investment, and then once you sell it for a capital gain, there's a tax concession. So it's not surprising, is it, that people put their money in it, and that increases demand, which pushes up prices? Isn't the system designed to do that?
I guess in terms of intent behind the design of the system, again, it's probably a better question for government. But I think, again, it just comes back to housing, you know, supply as a means to an end in terms of trying to have sound housing outcomes for a range of situations. And I think there's a range of factors that are impacting on that, which, you know, having a look at the RBA submission, for example, to this inquiry, they step out a number of the factors that are impacting on affordability. So I think it involves, as they said, it involves taking a holistic approach to to all the factors. But I think the starting point has got to be, well, what are the key objectives that we want to have with housing? Whether it's renting or whether it's purchase, and then working backwards from there in terms of what we think those objectives or what we think should be appropriate in delivering on those objectives.
Okay, thanks.
Can I ask, Julie, or the Deputy Chair asked a really good question about what we're missing in terms of different types of housing. But do we have a planning commission for bread production in Australia?
For what, sorry, Chair?
Do we have a planning commission for bread production, for car production, for sneaker and shoes and clothes and tie production? Why is our housing market so highly controlled and regulated and centrally planned? And why is it that we think that planners are better at determining what housing Australians want than Australians themselves?
I can answer that. I mean, look, I think it's a good question. I mean, I think that my answer will be no surprise, be pretty balanced. I mean, I think we have to accept there are externalities associated with developments, right? There's congestion, there's potentials of environmental degradation and other kind of issues. So there does need to be some planning that goes along with ensuring that we don't get a lot of externalities with housing development. So I think that's one thing. But I mean, in my observation, I think it's a reasonable point to sort of say, well, if builders and developers are identifying where demand is, why can't they go and build that housing as long as they're adhering to kind of rules that are kind of sensible and where the benefits outweigh the costs? And I think that you're probably hitting on something that's just really big here, and it's really the kind of canary in the coal mine to some degree, which is how do we educate local communities in terms of them understanding that when new development actually occurs. I think that I've spoken to a lot of people about this. There's a lot of examples and case studies where there's a lot of community opposition to these things, which I think feeds through to what sort of some local governments might do or not do on developer on DAs and that kind of stuff. But then after a development might get pushed through and built, there's a lot more favourable kind of sort of like an ex ante and ex post. The views can be very different. I mean, I can talk to some in Sydney, but I think that's a really, really critical issue, right? Because I think that we want to make sure, wherever there's demand or anticipated demand, we get housing built. But I also think we need to kind of deal with that community issue of knowing that, we generally have a country where we've got a sort of growing population, and that population needs to live somewhere, and communities need to kind of accept that. I'll leave it at that.
Fair enough. Thank you. If we don't make changes urgently, when immigration starts up again next year, what's going to happen to the housing market?
Yeah, look, we'll be sort of assessing some of these issues in our State of the Nation's housing report out next month. But a couple of things I would point to is, despite the sort of big shock, the once in a century population shock, we've now got vacancy rates in a lot of even the major cities like Sydney and Melbourne coming down. And certainly what we're seeing in the data at the moment is advertised rents starting to kind of go up again. And so if all other things equal, if we start to get very strong population growth in the next couple of years again, that's again going to put a lot of pressure and stress on housing markets and ultimately on housing costs. So I think one of the things I will leave you with as well is that one of the things that's been pointed out to us is the increasing sort of lead and lag times. Even a few years ago or 10 years ago, it might have been 2 or 3 years. Some developers are now telling us it might take 6 to 7 to actually kind of get, from that DA stage to, kind of actually getting stock to market. And so if you think about that in the current environment, then if it's going to take, 6 or 7 years to get stock to market in an environment where population's bouncing back very quickly, that absolutely is going to put pressure on housing markets.
So my final question is this. In other words, when immigration starts back up in Australia, which it needs to, because our regulations are so poor, our lead times are so long, and our charges and development charges are so high, the housing affordability crisis is only going to get worse.
Did someone hang up then? Sorry. Oh, look, I think there's a whole lot of contributing factors there, but certainly I think that the sooner we can get stock to market, right, and cut through some of these issues, that's certainly, all other things being equal, going to lead to lower housing costs.
I think the key issue, Chair, is really to plan ahead. I think that's one of the critical issues. You need to plan ahead in both land supply, supporting infrastructure to accommodate new household formation. And just to finish on your earlier point, at the end of the day, it's all about getting balance, I think, in terms of, the degree of regulation and approvals that you need, versus letting the market operate. And I think whenever you look at a basic need, whether it's health, education, health, you do see government taking a substantial interest. And I think the other thing I'd say is that the other key thing about housing, as opposed to some other products, is that for most Australians, housing is still the bulk of their wealth. So I guess it's also, from an equity point of view, housing is very important.
Indeed it is. Thank you, Mr. Darbon, and thank you, Mr. Hartigan. I just need to say these words, which are, if you have been asked to provide any additional information, please forward it to the Secretary by the 29th of November 2021. You'll be sent a copy of the transcript of your evidence and will have an opportunity to request corrections to transcription errors. Thank you for your time today. Committee, we are just going to adjourn until about, let's make it 10 o'clock, when we will hear from the ABS. So I'll see you all then. Thank you.
Thank you.
Yeah.
Gentlemen, I would now like to call the following witnesses to give evidence today from the Australian Bureau of Statistics. Ms. Michelle Marquardt, sorry, I've mispronounced that, I know. Mr. David Zargo, Mr. Neil Tickeram, and Mr. Daniel Rossi. For the Hansard records, would you please state your name and capacity in which you appear before the committee?
So my name's Michelle Marquardt. I'm the Program Manager for the Prices Branch at the Australian Bureau of Statistics.
And my apologies for my pronunciation.
No problem at all.
Sorry, gentlemen.
I'm David Zargo. I'm Program Manager for Household Surveys Branch at the Australian Bureau of Statistics.
My name's Neil Tickeram and I'm one of the directors in the Prices Branch at the ABS.
And is Mr. Daniel Rossi? Daniel, there you are.
Yeah, I'm here, Chair. Yep, so my name's Daniel Rossi and I'm currently the Director of Construction Statistics in the ABS.
Thank you, ladies and gentlemen. This hearing is a legal proceeding of the Parliament. Giving a false or misleading evidence is a serious matter and may be regarded as contempt of Parliament. The evidence given today will be recorded by Hansard and attracts parliamentary privilege. It is important to note that although your evidence is protected by parliamentary privilege, this protection cannot be enforced outside Australia. I would now like to invite you to make an opening statement before we proceed to discussion.
Okay, thank you, Chair. So look, we made a submission that covered a range of sources that we think relate to the terms of reference. Just in terms of context, we'd like to work through some slides. I'm just wondering, is it possible to share some slides? ABS loves graphs, so we could share some graphs to talk to. That would be good.
That is a question that Claire will need to answer definitively, but yes, we should certainly be able to do that.
Shall I try and we'll see?
I think you need to
Claire, you're on
unmute,
mute.
Claire.
Sorry, can you hear me? Great. Yes, if
Yes.
you'd like to share your screen, that's fine.
So hopefully I'm sharing now. Can people see that? Okay, fantastic. So look, just in terms of context, I thought I'd run through some of the information that we have at the kind of high level through the surveys that I'm responsible for. So this first one is a graph of home ownership and home tenure rates, home tenure trends over the last 20 years from the Survey of Income and Housing. And overall, over that period, we've seen a fall in home ownership from around 70% to around 66%. And we look at the components that are made up here. We see that for owners without a mortgage, that proportion of households has dropped from about 40% to 30% over the last 20 years. while we've seen an increase in owners with a mortgage from 31% up to 37%. And over that same period, we've seen households that rent through a private landlord increasing from 20% to 20%, 27% over that period. When we look at home ownership by incomes, this is also information from the Survey Income and Housing. We see that what's really been driving that decrease is actually amongst the second and third. So the middle income quintile has dropped from, in terms of home ownership rates, from 73% down to 65%. And for the second lowest income quintile, it's actually dropped from 68% down to 61%. We look at that home ownership by age of household reference person, again from the same survey over the last 20 years. We see again that it's driven by particular parts of the population that decrease. So for those aged 35 to 44, it's decreased from around 73% to 61%. And for those aged 25 to 34, it's actually decreased from 52% to 37%. So a lot of that...
Do you mind if can I just ask you, is this data census data or is it amalgam of data?
This data is from, so Census has a similar, reports on similar data trends. This is actually from the Survey Income and Housing, which is actually probably our best source of detailed information around housing. So Census is actually really useful in terms of having full coverage and being able to drill down into small population and small areas. But this survey actually collects much more detailed information and collects it in a way that we think is probably more accurate. It also is conducted every 2 years rather than every 5 years for the census, so it provides a really good trend over that period.
And are we to assume that pre-1995, those ratios remain the same or were relatively stable for a number of decades?
So there's been a slow decline, I think, over a period before this as well. And you can see that in census data. But this is the period that this survey has been run in the same kind of way. So this is a period that it's actually comparable for. So, but a slow decline over, to that same kind of degree over, extending beyond that period through census data too. So I'll keep going. The next slide is actually around housing affordability, which are also a report from that survey. So this graph shows total housing costs as a proportion of gross household income, again over the last 20 years. And you can see for most tenure types it's been fairly stable. If we look at the red line, which is owners with a mortgage, that's actually probably decreased slowly over that 20 years from about 18% to 16% in the latest survey. So, and this is a trend I think we see in other data series too, that actually housing costs as a proportion of income have actually been fairly stable, and obviously a big driver for that has been low interest rates over the last period. So it's actually going to hand over now, I think, to Michelle to talk to
Daniel.
To Daniel, sorry, to talk to dwelling approval.
Yeah, thanks, David. Yeah, so thank you, Chair. Look, dwelling approvals is a monthly collection of administrative data that comes from actually all the planning permits across the country, and we thank them for all their input. So what you can see from this chart is that in response to strong population growth and house price growth as well, dwelling approvals reached some unprecedented levels in 2014-15 and did remain quite high through the mid 2010s there, with over 200,000 approved per financial year through to 17-18. And that trend was largely by the apartment segment on the eastern capital cities. More recently, 1920 did have a little bit of a drop following some apartment oversupply in some markets and then the uncertainty at the outset of COVID-19. But you can see that bounce back there in response to some of those changes that happened both globally as well as home builder in the last financial year of 2021.
So Daniel, can I just ask two questions here? The first is, these are dwelling approvals, not dwelling completions, is that right?
Correct. Dwelling completions are on the next slide, but these are actually approvals, so from the permit authorities themselves.
Thank you. And the 20-year average, is it possible to adjust that for population growth or not?
Yes, I mean, we can look at things like dwelling approvals per 1,000 people, which is a commonly used measure, and that's roughly sitting at just above 2 dwelling approvals, kind of per 1,000 persons. But I can send through some of that information while looking at approvals compared and adjusted to population growth, which is quite interesting. And if we move to the next slide, David, you can see commencements and completions, which largely shows that they follow the pattern set by the approvals. So we have released some data, I think actually just in October, around abandonment rates. Abandonment rates are very low. So once you receive approval, something like 97% of dwelling approvals recorded in our collections do proceed through to construction. But can see there is a bit of a lag between approvals and commencements, and then commencements and completion. So that's the red line largely following the blue line. And there's obviously some delays in terms of both getting a commencement as well as being able to build the stock. The next slide highlights dwellings approved but not yet commenced, which is a pretty interesting story. This kind of shows that a lot of the run-up, even though we did have a very dramatic increase in 2014-15 in approvals, I suppose it shows some of the pressure on the industry to be able to build that stock quickly. So the red line there is other residential, which is largely think of as multi-story or higher density, so your apartments and your townhouses. And so that shows a significant increase in the dwellings approved but not yet commenced. Now you can see that's decreasing. Yes.
Yeah, sorry to interrupt there, but what we just heard from Nick was that you might be getting approvals, but then there's this massive lag at the local government level for, building approvals and development approvals to be given.
Yep. Look, I can't comment on that. What I can suggest is the approval that we get, so through our building approvals collection, what we consider the final approval, it has a different name in each state and territory. Effectively, it's the approval that allows you permission to proceed to construction. And so we do publish average commencement times. So it's also available. We published them in October, which is the average time between an approval and commencement. And that's largely been unchanged for houses and townhouses. So that's taking around two and a bit months from an approval to commence. New apartments have taken a little bit longer in recent financial years, and that's probably partly because there's been a significant volume. So you can see there the red line is very large volume of apartments all come on at once. And also some of the apartments are getting bigger. So we did release some information on average apartments becoming taller, which obviously increases complexity and some of in lead times. And the final slide is something new that we've only recently just published. So we are working on providing some additional information relating to dwelling stock, and one of the gaps is on demolitions. So the team at the ABS have been working with planning authorities, permit authorities to collect information on demolition approvals, which we've got and we've published back to September 2016, planning on doing that regularly. And what you can see there is there's been a large increase actually since the onset of the pandemic, since about May 2020 in demolition approvals, that is. So it's up about 30-odd%. And those will eventually likely translate into new dwellings and potentially knock down subdivisions and rebuilds of multi-dwellings. That's it from me, so I might pass over to Michelle.
Thanks, Daniel. So the first slide that I've got here is from a series that we call our producer prices indexes. So they measure, in this particular one, we're looking at the cost for builders of the supplies that they need to build houses. So what we've seen is that that's increased by 8% over the last 12 months. And you can see that that's quite a large rise in the last couple of quarters. So we're seeing the reporting that we're getting from the builders is that that's largely due to a shortage in materials, particularly timber and steel. and that there's high demand, which you can see from the slides that Daniel was just showing. So, next slide, please. This one is the output prices. So this is what the housing, so the builders are charging the buyers, the purchasers. In this case, it's gone up by 8.9% over the last 12 months, so a little bit more than their input prices have gone up. Again, that's being driven by costs of timber and steel, but the increased demand has also enabled the builders to pass on some of their rising costs that they're facing from the suppliers, and we've seen them reducing some of the bonus offers that they use to try and attract people to buy their properties. One of the other interesting indexes that we produce is around living cost indexes. So they include mortgage interest charges. So the blue line there is the mortgage interest charges that have been faced by employee households. So we break the living cost indexes up by different types of households, so employees or pensioners. Employees are the ones that tend to mostly have a mortgage, or obviously retirees have often paid their mortgage out. So what this slide and the next slide are showing is that it goes with the size of the loans. So whilst we're seeing in other data series that loan sizes have gone up, at the same time mortgage interest charges have come down, as shown in this slide. And then if you move to the next one, we can see that for employee households, which, as I said, are the ones who mainly have a mortgage, that the mortgage interest charges that they are facing have actually been decreasing a little bit, mainly, as I said, due to the falling interest rates. So for those people who've got a mortgage.
Can I just ask though, this is all households with mortgages, not necessarily households who've just bought houses in the last 2 years as prices ran up.
That's correct.
Okay, thank you.
Yeah. So this is all employee households who it's averaged across all employee households, and as I said, many of them do have a mortgage. So it's the costs that are faced by that whole cohort of people when they have to pay a mortgage. And as you say, that's not necessarily just the ones. It's not the ones that have just taken out a mortgage. It's across the whole shebang. And that's the end of our slide presentation. So.
Thank you very much. Now, Mr. Stevens has indicated that he's happy for me to take his time. Julie, Jed, are you still there? Jed? Matt, you'll have questions, no doubt. And Julie, Deputy Chair, I assume you have questions as well. So I'm going to assume there are three of us and we can finish this up at 10:30. So that gives each of us about 4 minutes. Gentlemen or ladies and gentlemen, thank you very much for that. That was really interesting. Can I say though that your statistics have now, to me at least, made the situation murkier rather than clearer. So one of the things that I'm interested in is that you say that dwelling approvals have increased over the last few years, have taken a dip more recently in the last few years, and have been above the 20-year average. But that doesn't really take into account for growth in population and immigration, does it?
Thanks, Chair. Yeah, so look, we can send through some more detailed information on dwelling approvals in comparison to the population. I mean, when we look at the data, what we can see is the number of dwellings approved, per thousands persons has largely fluctuated between 1.5 and 3 dwellings over the past 40 years. So that's total people, that's not new. So I suppose we could also look at this comparing dwelling approvals, new supply, compared to new population. And that's also been reasonably stable over the stretch, although I think there was a period in the early 2000s where that was a bit lower, and it seemed to have gone up. The 2014-15 increase did make a significant dent. So you can see there dwelling approvals remained very elevated for 4 or 5 years from the 13-14 financial year onwards.
And you can assure us that dwelling approvals are the final approval, because all the evidence that we've got up until your appearance here today is that, you know, when zoning happens, that's just when the fun starts. And in fact, NIFIC just presented us with evidence that one of the reasons supply is not coming to market, which one of your other slides indicated was the thing, was because builders cannot be sure how much they're going to be charged by local government and state government. So they're either abandoning or sitting on the development until they know, or they're not getting the approvals to build.
Yep. So what we collect is, you know, the approval that allows you authority to proceed to construction. The planning systems in the different states and territories do have different levels of approval. So for example, in South Australia, you can require a planning approval and then a building consent and then a development approval. So there are other levels of approvals that we don't collect that NIFIC may have been referring to, or were likely referring to, I think. What our collection is showing is the final approval that gives the applicant permission to proceed to construction. And in each state and territory, we've asked for those from the various planning authorities.
And that's and this is my final question, I'm sorry we don't have more time, but that's one of the other interesting parts that we keep getting evidence on, which is that people literally, there is no single source of data. So, you know, NIFIC, probably in the most damning evidence so far, said that not only are charges going up through the roof for people trying to build new housing, but also those charges are being hidden or not being made transparent. Is that also a problem that the ABS is finding in collecting data between the different jurisdictions?
Look, we don't collect any data on charges. You know, there are some challenges relating to collecting information on dwelling approvals because of authority is different in the different jurisdictions, but we largely, you know, work pretty well with the partners in local government and the state and territory planning permit authorities, who are pretty good at getting us comprehensive information on the final approval that proceeds to construction.
Or what they say is the final approval.
Correct, yeah.
So, okay. I mean, I really honestly think this is quite worrying, that we've had evidence before us that what councils say is, you know, what they're doing versus what is happening on the ground. There is quite a diversion. So I don't have to comment on that, but yeah.
I would. Oh no, I would just point out that the building approvals we get, we actually track in a survey called Building Activity, and we publish that quarterly, and that's one of the slides that are highlighted around commencements and completions. And so we do publish abandonment rates, so what proportion of approvals don't lead to construction, and we estimate that's very, very low. So we've got a lot of confidence in the monthly dwelling approval series that we publish. You can find that on our website. So abandonment rates are very, very low, around 2.5%. So what we're saying there is 97+% on average of dwelling approvals actually proceed through to commencement. And we do track those approvals. So we're pretty confident in the data we're getting for our monthly dwelling approval series.
Thank you, Daniel. Julie.
Thank you, Jason. Thank you very much for your submissions. They're actually really, really interesting. I've just got a couple of really quick questions first. On the homeowners slide, can I assume that's people who own a house, whether they live in it or not? So it includes investors in those figures?
So the figures that I reported are actually the tenure of the house that people are living in. So
living in? Okay,
yes,
so it's not investment properties.
It's not investment.
Cool. Okay, that's cool. The slide that showed the increase in the number of people still with a mortgage, do you have that by age group? Because obviously if lots of young people suddenly got mortgages, that would be a good sign. But if people in their 50s have mortgages, that starts to be a bad sign. So do you break that down by age?
So we do. Look, I can tell you that between 1995-6 and 2017-18, for households with a reference person aged 55 and over, there was actually an increase of households with a mortgage. So it increased from 7% to 23% over that period.
Wow. Is that a slow increase or a
So it's a steady increase over
steady
that
increase?
over that
Okay.
period. Yes.
Thank you. And a question, again, it might seem unrelated, but it's not to me. Do you keep data on other assets? You know, which percentage of the population has assets other than housing? Because, you know, moving away from housing affordability, if people were choosing to build assets elsewhere rather than housing, that wouldn't necessarily be bad. But
so I'm not sure of the trend, but we do. That survey does collect information on other assets as well. So that's available through that survey, income and housing.
And so you wouldn't know whether there's been, as housing became less affordable, people were investing elsewhere.
Yes, I'm not sure of that trend off the top of my head, but something we could supply.
Thank you. It's just a side issue, but it's actually, I think it's an interesting one.
Yeah.
You do collect the small area statistics surrounding dwelling stock, and you've been doing it now. You've funded for 5 years to do that, I think, over shorter periods. Hello?
So that's not in my
Sorry.
space. So
That'll be in my space, David. Yeah, so thanks, Deputy Chair. We have received some funding to look at providing more timely measures of dwelling stock. So the first release is looking at removals of stock, so demolition approvals, which is some of the data I showed earlier, and we've released that in October. We also have just released small area completions. So I did show that graph around total completions, but we've actually produced those at a small area level, so down to SA2 and LGA, and we can do those quarterly. And we've done them all the way back to 2016. What we're now waiting for is our next release of census data. So census will be an important release for us because we'll be able to take the information from census and use that to benchmark our flows backwards. And so what we will get from this new series that we are funded to develop and publish once, I think in around September next year, will be quarterly small area estimates of dwelling stock, including all the demolitions out and the additions of new completions in at the small area level.
And will you be able to compare those with income levels?
I mean, look, that may be potential for people to look at and compare income levels at the small area level and compare them to, you know, new stock and things like that.
Well, if the SA1s, then it's yeah, that's right. Okay, thank you. That's it, Jason.
Thank you, Julie. And Matt, sorry.
Thank you. Your submission mentions the surveys or the data that you publish on homelessness based on the census. Can you give us an indicator of what the trend is with that data at the moment?
So obviously we're still processing results from the latest census, but I know between the previous two censuses overall, there was a reasonable increase in the overall measure of homelessness. Yeah, between 2011 and 2016, but yeah, sorry, I can't quote the actual figures, but we could provide those.
Okay, yeah, that'd be good if you could. What about, you also mentioned in your submission, there's the situation with Aboriginal housing. Again, if you could, I know it's part of a broader survey, but if you could provide, and you may need to take this on notice, trends associated with Aboriginal housing, particularly rates of homelessness in First Nations population, but also the types of housing, whether they're in rental, ownership, and the like. That'd be valuable as well.
Yes, we can pull that together. Yep.
Okay. And do you do any work around the provision of social housing by the various states and whether or not that's keeping pace with population growth as well?
I can't think of any detailed reporting. The Australian Institute of Health and Welfare report, quite routinely on social housing, so they might be the best source of that data.
Okay. Great. And just finally, you may not be able to answer this, but the rates of home ownership that you outlined in your data set that you just presented, how does that compare internationally to, say, other developed nations like the United States, the UK, and Canada? Are they facing similar declines in the rate of home ownership?
Sorry, I don't think I can answer that off the top of my head.
Okay.
Apologies.
No worries. That's it from me, Jason. Thank you.
Ms. Carney has said that she will forego any questions under one condition, and that is that you agree to supply to the committee the slide pack that you presented to us. And if you do that, then she'll let you off the hook. So consider yourselves lucky and just provide the slide pack. Thank you very much, ladies and gentlemen. If you have been asked to provide any additional information, Matt just asked you for some pieces and Jed's asked for the slide pack as well. Could you please forward it to the Secretariat by the 29th of November 2021? You will be sent a copy of the transcript of your evidence and will have an opportunity to request corrections to transcription errors. Thank you for your time. The committee stands adjourned until 10:40, when we will welcome witnesses from the Australian Prudential Regulation Authority. Thank you. Roberts and Mr. Gideon Holland. For Hansard record, would you please state your name and the capacity in which you appear before the committee?
Yes, hello. Thank you. Renee Roberts, Executive Director of Policy and Advice for the Australian Prudential Regulatory Authority.
And Gideon Holland, General Manager for Policy at APRA. Thank you.
Thank you, Renee. Thank you, Gideon. I'll just say this very quickly. This hearing is a legal proceeding in the Parliament. The giving of false or misleading evidence is a serious matter, may be regarded as contempt of Parliament. The evidence given today will be recorded by Hansard Tracks parliamentary privilege. It is important to note that although your evidence is protected by parliamentary privilege, this protection cannot be enforced outside Australia. I now invite you to make an opening statement before we proceed to discussion. Thank you.
Thank you,
Renee,
Chair.
would you like to do that? Yep, Renee, thank you.
Thank you. Right. Thank you for the opportunity to appear today. I'm joined by my colleague who's just introduced himself, Gideon Holland, the General Manager of Policy for APRA. So APRA has made a submission to the inquiry, which we hope has been helpful in providing some context. In some brief opening remarks today, we wanted to explain APRA's role in the financial regulatory system, our approach to regulating residential mortgage lending, and our recent actions to address rising financial stability risks. Firstly, APRA's role. APRA supervises institutions across banking, insurance, and superannuation. In regulating banks, APRA's role is to set prudential requirements that are designed to protect the interests of depositors and promote financial system stability in Australia. We do this in close collaboration with other members of the Council of Financial Regulators. Secondly, APRA's approach to regulating residential mortgage lending. In residential mortgage lending, APRA seeks to ensure that banks are making sound credit decisions that are appropriate individually and in aggregate in the context of broader housing market and economic trends. APRA's prudential requirements, which are focused on lending practices, can influence the terms, amount and price at which banks extend housing finance. They do not target house prices or matters of affordability. Lastly, APRA's recent actions to address emerging risks to financial stability related to residential mortgage lending. Last month, we set an expectation that banks would assess new borrowers' repayment capacity at lending rates that are at least 3 percentage points higher than those currently prevailing. APRA's objective is to ensure the financial system remains safe, with banks lending to borrowers who can afford the level of debt they are taking on, both today and into the future. We expect the overall impact on aggregate housing credit growth flowing from this change to be fairly modest, since many borrowers do not borrow at their maximum capacity. I'd also like to draw the committee's attention to an information paper we released last week, which sets out APRA's framework for using macroprudential policy. Macroprudential policy is an essential part of APRA's toolkit for promoting financial stability. Our recently published framework covers the risk factors APRA uses to identify emerging threats to financial stability, the policy tools APRA can choose from, and the importance of consulting with other members of the Council of Financial Regulators as part of the decision-making process. So with these opening remarks, we are happy to take your questions. Thank you, Chair.
Thank you very much, Renee. We can't see you on screen. Not that that's a problem, but I just wanted you to be aware of that. Now, I think we have until 11:20, which is roughly 35 minutes, and at the moment, I've got 4 members, so I'm going to say each of us have 6, so about 8 minutes each. No, sorry, 6 minutes each. So I will commence with some questions. Renee, can I ask, does APRA in any way, shape or form feel that they should bear some responsibility for the boom in housing prices?
So in pursuing what we do, which is our mandate in terms of balancing financial safety objectives, we aim to ensure that banks effectively manage the credit risk of their loan portfolios. So we don't prohibit any types of lending. We do require that greater capital is held against higher risk loans. Our rules are sort of principles based rather than prescriptive. And so, indirectly, there is an impact, and we can impact the pricing of credit and the flow of credit. So indirectly, there is potentially an impact, but there isn't anything that we do directly that impacts housing affordability.
Okay, so
I don't know, Gideon, if you wanted to add something to that.
Yeah, so I'm just going to interrupt you there and say, you say that you don't do anything prescriptive. Was it in 2014 or 2015 that you introduced macro prudential controls around how much lending banks and other financial institutions could give for investor loans in property?
So yes, there were some macroprudential tools and levers that were used then. Gideon was around then. I wasn't at APRA at the time. So Gideon, did you want to just talk to what we did back then?
We don't really need to know what you did back then. My question really goes, you did do it. You did say to financial institutions, you're not going to lend money for the purposes of investment in property, or we are severely limiting how much money you can lend. You did do that, right?
So perhaps I could.
Yes, we did, and that was in response to again what we saw were financial stability risk rising from a deterioration in lending practices.
So why don't you do that now? So why don't you try to limit the increase in housing prices now by not allowing people to buy properties for the purpose of investment and only making it easier for owner occupiers?
Perhaps I could just give a bit of colour about, so December 2014, APRA wrote to the banks to set a benchmark on very excessive levels of growth in investor lending. So that benchmark was set at 10% annual growth in lending. That we didn't want to see banks lending above that rate. At the moment, investor lending is running around 3%, and while it has been picking up, it is still relatively low and low relative to what we saw back in December 2014. The reason we intervened in 2014 is the same reason we intervened recently, and that was around the risk to the banks, the higher risk lending. In the current environment, our concern is very much around serviceability. So lending, for example, at high debt to income multiples. And that lies behind the move that we made recently to recommend a higher serviceability buffer. So the risks have changed since 2014.
So basically put, if I can be blunt, APRA doesn't care about affordability in the housing market. The only thing you're worried about is whether how the increase in the cost of housing directly or indirectly threatens the stability of the financial system in Australia.
Renee, do you want me to answer that, or?
Yeah, so
it's a pretty yes or no question.
Chair, thank you. It's a complex issue, and I wouldn't go so far as to saying we don't care, but it is not in our mandate to do
so you don't
to address
so
housing
in other words,
affordability.
Okay, so if it's not in your mandate, it's not a matter of concern for APRA.
No, it's not. If we're talking about housing affordability specifically, it's not in our mandate.
So that is not a concern for you. What is of a concern for you is if housing as an asset becomes so big that it actually, and so, well, one hesitates to use the word bubble, but the prices of that asset depart from the underlying long-term average to an extent that, in your view, it threatens the financial stability, the stability of the Australian financial system. That's when you would intervene. That's your concern.
So rising house prices and you know, credit growth that's rising at rates that are what we're seeing at the moment, we would see that those as risk factors, yes.
Right, but whether people can afford to buy a home to live in, that's not in your mandate. That's outside your area of concern.
Yes, it's not within our mandate. So we don't target housing affordability.
I appreciate your directness and clarification on that matter. Thank you. Deputy Chair for 6 minutes.
But you do care about the debt serviceability of the house. So while the price of the house is not the point for you, whether people can service the debt is. Is that right? So they're
right.
kind of related. Yeah. Okay. Understand. Yes. Yeah. You state that the recent increase in serviceability buffer is not expected to have a material impact on aggregate housing credit growth, which sounds counterintuitive to me. Can you explain why that is?
Yes, I'll go through what we did. So we increased the serviceability buffer by 50 basis points. So it was sitting at 2.5, and we increased it to 3. And so this is about being able to, and it is at the point of application. So assessing the capability of a borrower to repay at the loan product rate plus a 3% buffer. Mm-hmm. So based on the modelling we did, and again, it is complex, but we expect that reduces the maximum borrowing capacity of someone who is at the limit by approximately 5%. We see that the impact will be larger for investors than owner-occupiers because the investors tend to be more highly leveraged. But it does impact all borrowers, particularly if you are at that margin.
Thank you. You also mentioned that there's an increasing prevalence of borrowers seeking to borrow at the high debt to income level. Do you have any insight as to why that's occurring and what the impact is, what that is having on the housing market?
So Gideon, you've got some detail around the growth in the high DTI?
Yeah. So, I mean, to put it simply, the level of debt that borrowers are seeking to take out of a bank is growing at a faster rate than income growth. So that multiple therefore stretches upwards. Now, banks can influence that in a number of ways. They can influence it through their risk appetite settings and also through their lending standards. The most direct way of influencing that through lending standards is that serviceability assessment rate that Renee was talking about before. And that's where APRA moved to ensure that was set at a much more prudent level.
Thank you. Thank you. You've said in your submission too that by setting the prudential requirements of ADIs, you can influence price ultimately. Can you explain to me what that influence is? Really dumb question. Is it up or down?
Renee, do you want me to take that, or do you want to?
Yeah, you take that one, Gideon.
So it depends. Sorry to give you an
right.
answer that sits on the wall, but it depends on the changes that have been made to lending standards and also how borrowers and banks react. So with a change in the serviceability assessment rate, that is like a stress test on the borrower. It doesn't actually change the price of credit or the lending rate that the bank makes. With other changes that a bank or APRA could suggest, such as changes to risk appetite or other forms of lending standards, the bank may seek to meet those lending standards or controls on high risk lending through changes to its lending rates.
Can I ask, I don't know how long I've got, Jason. I'm just asking whether or not we're in a kind of runaway situation where with higher prices and low interest and the filters you've put on to filter out the stressed borrowers, whether we're in a situation where those that can afford are just going and going and going, and we're kind of stretching the market.
So it's a difficult one for APRA to answer because obviously we don't price regulate credit. So while we can take steps to make sure that banks reduce riskier lending, there's not anything in our toolkit that would directly control or directly influence the price of credit.
Do you look at what's happening at the moment in the housing market and worry beyond what you've actually done?
Absolutely. I mean, so APRA has been watching the housing market for many years as it goes through different cycles. In the current environment, the reason we intervened was because we were concerned around the combination of low interest rates, high and rising house prices, and what we saw was an uptick in higher risk lending, so especially that high debt to income lending increasing. The reason why we intervened was not to influence house prices per se, but to ensure that banks were lending to borrowers that could afford to repay.
Thank you. Thanks, Jason. Thank you.
Thank you, Julie. James, if you're there for 10.
Yeah, can you hear me?
Yes.
Oh, great. Can I pick up on what Julie was just exploring? Because I think that's the crux of it. I mean, you've said, yes, you are concerned about the growth in house prices. You've obviously got internal models, I assume, that are looking at the risk around that growth and people getting into the market right now. And if the market undertook some kind of recorrection, what that would mean to the risk of default rates, etc. Is there any comment you can give us on what your modelling is showing based on, hopefully a scenario that doesn't come about, but nonetheless one where there is a market recorrection, house prices drop by a substantial amount? Do you have modelling that indicates where that would, or what that would look like?
So Gideon, I'll take that one. And hello, everyone. Apologies, it took a little while to get my video going. So back in December last year, we did conduct some stress testing of the banking sector, and we looked at a very severe stress, and it was, off the back of the pandemic. And it is safe to say that we have a very strong financial sector. Financial system or financial sector, the banks are well capitalised, liquidity is strong. And even under that severe scenario, we saw that the loss rates of banks increased to about 2.3%. And so from a financial stability perspective, while we are, monitoring lending standards and high DTIs, and we have our macroprudential toolkit, from an overall perspective, at this point in time, we don't have any prudential concerns. Gideon, did you have anything to add to that?
I mean, I need to add that house prices going up or down in and of themselves would not be the concern. So with house price falling, it's really the confluence of that with poorer economic conditions, such as a rise in unemployment, that really starts to produce loan losses and therefore prudential concerns for the banks.
So we've had some evidence or commentary about really the challenge now in getting into the housing market is saving your deposit. debt is so cheap that really it's about, you know, scraping together that amount if it's say 15% or 20%. And I suppose if you follow that logically through, this might not be borne out by facts you've got available to you, but it's the evidence that we've received that effectively interest rates being so low, the cost of debt is not a limiting factor, because saving the deposit is the challenge that, you know, is much more substantial. So we've really got a situation now where people are just saving as much as they can to get their deposit, and then they'll borrow the maximum amount that they can borrow based on, you know, what that deposit saving capability is. Do you concur with that as a general point, as where the market, the lending market's at the moment?
Mr. Stevens, yes, thank you. Yes, we do concur with that.
So James, could I just step in there for 1 second? So Renee, this was an argument put by the Reserve Bank, and we have them shortly. Does that not strike you as ludicrous?
Sorry, Mr. Fulinski, what would strike me as
ludicrous? That the argument being put forward by a major regulator in our financial system is that people will pay as much as they can possibly afford for no other reason than the fact that they can afford to pay that.
So what we see in the market for first home buyers in particular, that the deposit is the constraint for them. Serviceability is not the constraint, but the size of the deposit generally is. So we do see first home buyers borrowing it at higher LVRs, but the serviceability is generally not the issue. And you know, other owner occupiers and investors, you know, we see investors borrowing at higher DTIs than generally first home buyers.
So in other words, the government's policies to allow for lower deposits is a positive one.
The assistance that the government has provided first home buyers, is that what you're referring to?
Yes.
That supporting first home buyers is a positive move. It's a good government measure, yes.
Okay. So the Reserve Bank at their previous appearance before this committee, and I do apologise to Mr. Stevens for taking up his time, but they...
Well, this isn't my time, it's yours.
Oh, indeed it is. I'll have to pay it back, don't worry. The issue is the Reserve Bank said, look, one of the reasons prices have expanded is because people can afford to borrow more money. Does that not strike you as a bizarre take on how market economics works?
Well, it's a demand issue.
Or is it because there is pent-up demand and we have an expanded supply? I mean, let me give you this analogy. I went and bought fruit on the weekend, and I paid about 75 cents per mandarin. And I don't know if I got a good deal or not, but when I got to the counter, I still had money left over. I didn't increase how much I spent for the mandarin just because I could afford to pay more. But I might have done that if there weren't enough mandarins in the store. I mean, that's a fair understanding of how demand and supply works in a market economy. Okay. Sorry, Mr. Stevens, thank you.
Well, that's all right. I suppose just to finish, because those are some of the things I was looking to explore too. I mean, ultimately, it just does seem like a frightening circumstance, particularly people getting into a hot market right now where they're basically borrowing as much as they'll be allowed to borrow based on that comment just then against their deposit. And that, you know, in APRA's stress testing, I mean, if I'm not wishing for any of this to happen, but if the market recorrected significantly, we talk about once in 100 year events now, thanks to COVID pandemics, etc. I mean, if the market dropped badly, you know, in the next few months, like really badly, 15, 20% style, we've got a situation where some people will be pushed to virtually into negative equity, plus they've extended their borrowing to the maximum amount based on their deposit, because their view is that debt is not going to be, or the cost of debt is not an issue when you're talking about making a commitment to a loan for 30 years, and a 30-year average interest rate you would have thought would not be anywhere near as low as 3% above the current historically low rates. You've made an intervention around the 3% mark, but I suppose my question is, in your worst case modelling, is that anywhere near enough?
Perhaps I could just step in. I mean, so 3% was a significant move from where we previously had the guidance set at 2.5%. It's also in line with where a lot of regulators internationally have set their buffer in their jurisdiction. What we think is that that will provide some capacity for borrowers to absorb an increase in interest rates or other shocks to their income. But as Renee said, what we've also done is a lot of stress testing on the health more broadly of the banking system. And as we said earlier, it really is a confluence of a drop in house prices with poorer economic conditions that would be a concern for the banking sector more broadly, rather than just a move in house prices by and of themselves.
Thank you.
Thank you, Mr. Stevens. Matt.
Thanks for your evidence. Is the riskier part of the market the investor market or the owner-occupier market? Where is the concern greater?
So it's generally where we see higher leverage. So what we would class as the higher risk lending is interest only and investor, and long-term interest only.
Okay, so it's fair to say, is it, that if there is a correction, if it's a reduction in house prices, it's predominantly being caused by riskier lending associated with investors rather than owner-occupiers?
So, I mean, economic downturns, particularly where there's impacts to income, can affect everyone. But where we see the riskier end is where there's higher leverage, and so high LVR, high DTI, and then various economic shocks.
But the measures that you put in place to manage that risk have an equal impact on investors compared to owner-occupiers, don't they?
The measures that we've put in place in respect of serviceability impacts everybody, but it is for those at the margin of that serviceability. And so what we do see at the moment in particular is that the higher DTI lending is for investors. Gideon, is that right?
Yeah, so a higher proportion of investors will be borrowing at those higher risk, high DTI levels. So an increase in the serviceability rate will affect all borrowers, but it should have a proportionally a bigger impact on investors rather than owner-occupiers or first-time buyers.
Not this round of measures that you've made to increase serviceability requirements, but the last series of changes that you made, particularly to interest-only loans. One of the criticisms that you faced from the non-ADI, well, not the non-ADI lending sector, but the non-Big Four players in the market around the growth of their loan books was that that the advantage was well and truly with the Big Four because they had the majority of the loans. Yet those smaller non-Big Four players couldn't grow their loan books because there were restrictions put on them. So they felt that that was a handbrake on competition, and that it was favouring the big four players. Is that the reason why you haven't gone to that measure this time? That you're aware of that criticism and you thought that there was some validity to it?
So this situation that we're in, that we've responded to, is different to the last time we intervened. Last time it was about lending standards to that which we were worried about, to that higher risk end of the market. This time it is about what we saw as the credit growth and higher debt to income. And so we do ensure that, or we do look at and try and ensure that there is competitive neutrality with our measures, but it is a different situation this time. So this one was targeted very much at serviceability, as opposed to that, what we did last time, which was around high LVR investor and interest-only lending.
Was there, and I know you don't go out of your way to do this, but was there an effect on competition when you did target the higher LVR approach last time?
Gideon, did you want to take that? You're probably a bit closer to it than I am.
Yeah, so there's been a number of studies into the impact on competition. I mean, most recently, last week, we released our macroprudential policy framework, and towards the end of that document, there is an analysis of the impact on competition of those measures. There were two measures over the sort of 2014 to 2017 period. One was on benchmark on investor growth, where we saw that being excessive and above 10%. The other was on interest-only lending and just ensuring that banks maintain just prudent risk standards. And there is a different impact from one or the other in terms of the competition impact. Whenever APRA makes a decision around macroprudential policy, competition is very high in our minds. So it's one of the many factors we assess and take into account when thinking about what measures to deploy. But the overriding, as Renee was saying, the overriding target will be the risks that we're trying to manage.
In your submission, you point out that there's an increase in non-performing loans in recent years. Is that something that you're concerned about as well?
Gideon, did you want to grab that one? We're always concerned about non-performing loans.
So there has, I mean, unsurprisingly, given the COVID-19 experience and the deterioration in the economic conditions, we weren't surprised to see an uptick in non-performing loans. They are not at worrying levels, at current levels. And as Renee said before, the banks are very well capitalised and we think very strong to be able to absorb that level of bad loans at the moment.
How does Australia compare to other nations in terms of the amount of capital that banks are required to hold? I was under the impression that New Zealand had moved their prudential standards to make them much safer, and that we were looking to do a similar thing. Is that still the case?
So we have been working on for a while and about to release our Basel III capital package, which won't increase the level of capital in the industry because we are already at an unquestionably strong level. And Gideon can talk a little bit more to some of the changes that we've made over the last couple of years. But we do believe that the Basel III package will improve flexibility and the strength and stability of the financial system. But in terms of overall capital levels, they're very, very high and an unquestionably strong level, and compare very, very favourably to other markets.
And just to support that, we target a level, or the Financial Systems Inquiry recommended that we target a level of the Australian banks being at the top quartile internationally. That's where they are today, and the reforms that we've made to the standards, we think will ensure that they remain in that top quartile for years to come.
Do those Basel III changes require an increase in the amount of capital held?
They don't require an increase for the industry as a whole today. What they do is strengthen minimum requirements and buffers to make sure that that level of capital is locked in for the future.
Okay, that's it from me, Jason. Thank you.
Thank you. Jed, are you online? If not, I've just got some follow-up questions. Would it be preferable in terms of financial systemic stability for people to have loans that are easier to pay down and to maintain?
So, Chair, thank you. It's important that when people borrow money that they're able to service and repay what they've borrowed.
So from APRA's point of view, which is your only concern is stability of the financial system, it would be better if people were purchasing houses at lower prices, because it would make the serviceability of those loans easier to maintain.
So Chair, we're also concerned about the financial stability or the safety of entities, of the banks themselves. And at the moment, lending standards are strong, and the ADIs are lending prudently, which on that basis, people who are borrowing can afford to pay back what they're borrowing based on the decisions that the ADIs would be making at present.
Okay. And, but it would be better, would it not, if the loans that people were buying were more serviceable. So what we've seen over 50 years is that the ratio of household disposable income to pay off the average mortgage has moved from 30% back in the 1980s and 90s to 40% now. So there's been a roughly 35% increase.
So absolutely, it is tighter now in terms of debt to income. Yes, it is tighter now than it has been in the past.
And this creates while I'm not saying that our financial system or our entities are under stress, it does lead to lower levels of stability in the financial system over the long term.
So it's a complex issue, and it's hard to make a completely direct link between those two. So but it's a risk factor.
Well, let me put it differently. It stands to reason that if the level of serviceability for your average mortgage is higher than lower, that your financial system is more exposed to external shocks.
I mean, that's why we have serviceability buffers, to be able to handle shocks for income and expenses.
Yeah, okay, understood. So over the last 40 years, serviceability ratios, or the ratio of repayments on a mortgage as a proportion of household disposable income, have increased by slightly over 33%. Okay. So it would be better if people were able to live in or to purchase a home at a lower price.
For the system as a whole, absolutely. High household debt relative to income, and ensuring that borrowers individually can repay the loans that they take out. That's a strong focus for us. In terms of the banking system, though, it comes back to a combination of ensuring that it is well capitalised that it can withstand a downturn in economic conditions. So it's not just house prices in and of themselves. It would be the confluence of that with poor economic conditions that APRA would worry about. What we've done in response is therefore to ensure that there is an unquestionably strong level of capital in the banking system and that they lend prudently through the cycle.
So where does Australian household debt sit globally?
I mean, we're not we're the prudential regulators. We're not the economists, and I think you know the RBA position is probably the one to look at.
Usually it's we're not lawyers.
No, we're not the economists.
So it is fair to say though that household debt in Australia is the highest in the world. Yeah,
it's high.
Yeah. And it would be better, well, you're not going to answer this question because you're prudential regulators, not economists, but it would be better if it were lower. I think we can all agree. So we have a situation where people are paying very high prices for housing, and that is creating a situation where we have one of, if not the most indebted household sectors in the world. And that this is creating, this obviously is a matter of concern in a prudential sense for our financial system. Yes.
So it's a complex issue, and yes, and so and the tools that we have at our disposal is the macroprudential suite of tools that we have. If we see risks in the financial systems, financial stability risks that we need to deal with in conjunction with our CFR colleagues.
I guess what I'm getting to is I'm actually looking at a speech made by Guy Dobell, the evidence you provided today, which is effectively our housing market. You know, our 5 capital cities are all now rate in the top 25 globally most unaffordable cities in the world. Sydney is only beaten by Singapore and Hong Kong. Despite the fact that structurally we have enough land, we're very well paid by world standards. So the question then becomes though, another one of the costs of that is that we are having to constrain our financial system and our ADIs and monetary policy, which is not a question for you, because of the potential bubble being created in this particular asset class.
Chair, was that a question?
That was absolutely a question. I can see Julie's come back online, so it's a very good question. Because when I get her interest, I know I'm doing a good job.
I'm just going to try and help here. The price of the house itself seems to me that is not the issue. That if our houses were miraculously half as expensive, but the banks were lending carelessly, you would still be concerned, right?
That's right.
It's not so can you say back in your words that it's not the price of the house, it's actually the serviceability of the loans that the banks are giving to people.
Ms. Owens, yes, you are absolutely right. So we are concerned about serviceability. We're concerned about loan to value ratios. So in the event that borrowers can't repay, we want to make sure that there's enough collateral there so the banks don't incur, losses. So yes, so we are not concerned about the house prices in and of themselves.
But equally,
they are a risk factor. Rising house prices and a high debt to income and credit growth, and all of those are risk factors that we consider in the overall financial stability of the system.
So, but debt is driven. People are borrowing money to buy houses. The higher the price, the more debt they have to borrow, right?
So it depends. So it depends on the quality of the lending. So good lending.
No, I understand that point, but the quality of the lending is being driven by how much you have to lend. People are borrowing more because they have to spend more to buy something that doesn't need to be that expensive? That's my question.
Yeah, so absolutely. If a bank was lending at a very high multiple of a borrower's income, so we tend to look at debt to income ratios above 6 times. That is an area of concern for us, and we did see an uptick in that, and hence we intervened.
And no one's going to be borrowing more money than they have to. They're only going to borrow how much money they need to purchase the house. Like no one's going to go to an auction and say, I know you're going to sell me this house for 750,000, but hey, I'm feeling generous today. I'll give you 1.5 million, are they? No. Okay. So I don't know why this is. So clearly people, if you've got house prices out of control or house prices increasing at a rate far above inflation, then that is obviously going to drive risk factors into the financial system.
Yes.
Okay, thank you. That's Julie. Do you have any other questions?
I was just going to add that would be particularly the case if you thought that the house prices were inflated by people's capacity to pay at that end of the market.
Well, okay. So I'm going to. We've had this discussion, and I really want to nail that point down, which is it the belief of APRA that people pay more money for goods and services, including houses, just because they can afford to?
And because they have to get it.
Well, but that's a separate issue. See, the Reserve Bank has given us, their evidence is that people are paying more for housing because they can afford to. Now, I think Julie and I are saying, no, they only pay more for housing because they have to. There's a difference.
So Chair, as I said, I mean, we don't know the psychology of borrowers, so that's not our area of expertise. So we would take the RBA's guidance on their assessment of the industry and what's happening.
Okay. Julie, do you have any other questions? Matt, James?
No, I'm fine, thank you. And thank you for your, it makes sense to me. Thank you.
Thank you. I'm glad,
Julie, you might end up governor of the Reserve Bank with careless comments like that. Renee and Gideon, thank you for your time today. If you've been asked to provide additional information, could you please forward it to the Secretariat by the 29th of November? You will be sent a copy of the transcript of your evidence and will have an opportunity to request corrections to transcription errors. The committee is now adjourned until 11:30 when we will welcome witnesses from the Reserve Bank. Thank you. Now declare the hearing open again, and I now welcome witnesses from the Reserve Bank of Australia, Dr. Lucy Ellis and Dr. Bradley Jones. For the Hansard record, would you please state your name and the capacity in which you appear before the committee?
Lucy Ellis, Assistant Governor Economic.
Brad Jones, Head of Economic Analysis.
Thank you, Lucy and Brad, and thank you for appearing again. This hearing is a legal proceeding of the Parliament. Giving a false or misleading evidence is a serious matter and may be regarded as contempt of Parliament. The evidence given today will be recorded by Hansard and attracts parliamentary privilege. It is important to note that although your evidence is protected by parliamentary privilege, this protection cannot be enforced outside Australia. I now invite you to make an opening statement before we proceed to discussion, or are you happy just to go straight to discussion, Dr. Ellis?
Thank you, Chair. I do have an opening statement.
Please.
Well, thank you for the opportunity to appear again before this inquiry into a very important topic. Shelter is a fundamental human need, so naturally housing affordability is a keenly felt issue. Its importance is highlighted by the number of parliamentary and other inquiries on housing over the past 20 years. Our submission to this inquiry covers a range of aspects of this issue, and in my opening remarks, I'll confine myself to some observations about the longer run context for housing markets, and then outline some noteworthy features of the current situation as Australia emerges from the COVID-19 pandemic. The longer run context is that financial deregulation in the 1980s and the global decline in inflation in the 1990s combined to reduce nominal interest rates. With lower interest rates, people could service a bigger mortgage with the same repayment. Some of this extra buying capacity financed an increase in the quality of the housing stock. But because most of the housing stock was already in place, the main effect was to bid up housing prices. This was captured in land prices. There were some distributional consequences to this. The price increases were greatest in the most desirable regions and neighbourhoods. First home buyers now had to save a bigger deposit relative to their incomes. And some features of the tax system, combined with the possibility of leverage, meant that buying rental properties became especially attractive. The big picture story, though, was one of increased demand stemming from greater availability and serviceability of finance. The pandemic and policy responses to it have shifted the balance of supply and demand in some housing markets. Over the past year or so, we have again seen strong growth in housing prices. This followed periods of weakness in 2018 and early 2019, and again briefly at the very beginning of the pandemic. Properties coming onto the market are being snapped up very quickly at the moment. Data on housing finance shows that this increase in demand was initially mostly owner-occupiers, but demand from property investors has also increased more recently. Clearly, some purchasers are willing to pay these prices, although others have missed out. Indeed, strong rises in housing prices have been a feature of many advanced economies' recoveries from the pandemic. This is not surprising when interest rates are low, incomes were boosted by fiscal policies, and many households are cashed up with savings accumulated during lockdowns. Another common feature across countries is that many households are wanting larger homes than they did before the pandemic. The combination of the time confined at home during lockdowns and the likely feature of more working from home has brought the quality and size of one's home sharply into view. We do not know how lasting this shift in preferences will be. For now, though, renovation activity, commencements for new detached homes, and price growth of high-value homes are all at high levels. This demand response to the pandemic relates to the quality and comfort of each individual home. And this is a very different margin of adjustment than the number of new homes. In Australia, additions to the housing stock have run ahead of population growth for a number of years. This led to higher vacancy rates in the largest capital cities. Vacancy rates in the two largest cities rose further following the onset of the pandemic. With the international border closed, population growth dropped sharply. At the same time, the home builder subsidy and similar state-based grants have encouraged more home building and will for a while yet. So it's hard to see the ingredients of an obvious overall shortage of homes in this combination. If Australia had not been building enough homes to house its population, you would have seen rents rising across the country. Instead, in recent years, the situation has been quite mixed. In the larger cities where most of the new apartments were built, rents were quite flat. Lower migration and other shifts in population in response to the pandemic and related health measures have mostly exacerbated these trends. Rents have been quite weak in the two largest cities of late, but in some regional areas, pressures on rental affordability are reportedly quite acute. As we outlined in our submission, the supply side of the housing market has inherently limited capacity to adjust to sharp increases in demand. There are some things that could be done to make the flow of new housing supply more responsive. These include speeding up the planning systems to reduce general inefficiencies, improving transport infrastructure to increase the supply of well-located land, and lowering the cost of new construction. Supply-side changes of this nature would dampen the increase in prices that ensues when demand increases, but they will not undo the fact of rising demand, and they will not prevent price increases entirely. Moreover, housing market policies that add to demand will only amplify any upswing in prices. My colleague Brad Jones and I would be happy to answer any questions you may have about the bank's submission. Thank you.
Thank you, Dr. Ellison. Thank you, Dr. Jones. We have you down for an hour and a half, but we will obviously try to get you out sooner than that. And the reason we asked you to come back was in your initial evidence before the committee, you raised a number of intriguing points, and I was hoping that we could explore some of them. So, for example, you said when you first appeared before us that you don't increase affordability by giving more money to spend on housing. Does the RBA accept then that by lowering interest rates, that's what you did?
To the extent that low and stable inflation means lower nominal interest rates on an ongoing basis over a run of some decades now, then at some level that is our doing. I guess the response I would have is that the alternative was being a high inflation country, much higher inflation than our peers, and that would involve difficulties attracting capital. It would involve economic instability, and there are swings and roundabouts, but I know which one of those two configurations I would prefer.
Fair enough. So in a sense, you accept some, well, when I say you, I mean the Reserve Bank accepts some responsibility for the housing boom.
We recognise that it is a natural consequence of moving from a high inflation, high nominal interest rate world to a low interest rate, low nominal inflation world. And in particular, where you go from a highly regulated, constrained supply of finance to one that is more market-based, that one of the consequences of that will be that people can service a bigger mortgage on the same repayment. And so with the same income, they can therefore service a bigger mortgage and they will tend to therefore bid up house prices. We've been saying this for more than 20 years. We've recognised that this is a consequence of being in a low inflation environment.
Dr. Ellis, you sound like me talking to my daughter. I have been saying things to her for a number of years too. So could I then ask you this question though, because it is, you're quite correct, a theme of your reports from about the early 90s through to today. But serviceability as a percentage of household disposable income has gone up from the mid 80s at about 30% to about a little over 40% today. Do you think that that demonstrates that actually housing has become more unaffordable in Australia?
I would refer you to graph 5 in our submission. Serviceability has been broadly constant. I mean, looking through all the swings and roundabouts, but the serviceability on a mortgage has been broadly constant for about 25 years. Making the distinction between the 80s and subsequent to that, there was, of course, considerable government regulation on the provision of finance. So there was artificial constraints on the provision of finance at that time. And so once that particular constraint had been lifted, people were then able to borrow up to a point where they could, where they could reasonably service it, but then the constraint becomes what you can reasonably service, not an artificial regulatory constraint, as we had in the 70s and 80s.
So your thesis is that people essentially, the limitation of what they were willing to spend as a percentage of their disposable income was not a matter of personal choice, but rather regulatory oversight by regulators that limited how much they could borrow.
In the 70s and 80s, yes. Since the deregulation of the 80s, the fundamental difference has been that then inflation fell, nominal interest rates fell, and therefore people could service a bigger mortgage on the same repayment.
So I just want to be, this is for my benefit. So what I'm hearing you say there is that as households became used to a low inflation environment by the mid 90s, that encouraged them to borrow more for their house. Well, sorry, that gave them comfort to borrow more for their housing because they felt that they would be in a low inflation, low interest rate environment for some period of time.
The relevant constraint is the repayment, not the overall size of the mortgage. And so the consequence of having lower interest rates was that for the same serviceability constraint, and I want to make an important nuance there, for the same initial serviceability constraint, that mapped into a larger mortgage, and therefore that corresponded to the ability to bid a higher price. But I also want to make an important distinction here, of course, is, people are paying their mortgage down over, 25 years or so. And so the accumulated amount of interest that they end up paying is also lower. So most people don't actually stay in the one home for 25 years, but if you conceptualize a single, you buy a home, you live in it, you pay off your mortgage. In a high interest rate world, you end up paying more interest overall, but your income probably rose more quickly, and so the burden of those repayments declined more quickly. You inflated your debt away more quickly. In a low inflation world, you end up paying less interest overall, cumulatively, but the burden of that repayment doesn't inflate away quite as quickly when you've got lower nominal income growth. And I mean, our former governor, Ian Macfarlane, gave a really good speech about this in 2003, where we showed these little, the shark fins, graph of mortgage. The burden of mortgage servicing is different. This is a consequence of being in a low inflation world. There are distributional consequences, and the balance sheet configuration you end up with is different.
And of course, but you also had massive asset inflation as well.
Well, that is a consequence of that the level of asset prices that correspond to that same capacity to service is now different, because you're now discounting your asset at a different interest rate.
Okay, so I'm going to come back to that, because the RBA says that's a consequence. Later on, I'd like to examine that, because I don't think that is necessarily an outcome you have to have. That is an outcome we've designed. But can I move on to other parts of your submission, where you've examined higher rates of population growth as a driver of house prices. So during 2020-21, we saw net migration obviously fall to pretty much close to zero, but we saw house prices continue, well, they skyrocketed. Does that mean that we may have overstated population as an issue?
I think a really good way to triangulate an understanding of this is to look also at the rental market. I don't think it's possible to look at the housing market without looking at the rental part of that. And Brad may want to chime in with some of the detail on the facts. But what we've seen is there's been a sort of a redistribution of housing demand. The closure of the borders and the cessation of a flow of immigration has primarily affected the two largest cities. And so you've seen that in vacancy rates, you've seen that in rents. Whereas, because people from the regional areas were not flowing, there's always a net flow in both directions. And as a consequence of the lockdowns, the people who were in the regions who would ordinarily move to the cities were not doing so. There were still people moving out to the regions. And so what you're seeing is, tight rental affordability and very low vacancy rates in some of the smaller cities and regional areas. But what you're seeing in the bigger cities is, high vacancy rates, low, very, very weak rental market. And consequently, what we're seeing is, this sort of redistribution. But as a general proposition, if you don't build enough new homes to house your new people, you will end up with that bidding up house prices. But it is not the only influence on demand, and so it's not the only reason why house prices might rise. And as I mentioned in my opening statement, the combination of very low interest rates, people who are cashed up because they haven't been spending during lockdowns, and re-examining whether maybe I need a home office in my home, have all contributed to the most recent episode of strong house price growth. And we've seen that in every country. It is not an Australian specific, development.
So I'm looking, Brad, did you want to add to that?
Yeah, no, thanks, Chair. I just add that when we think about periods of time as short as those you just mentioned, say 18 months or so, just the nature of the supply response in the housing market means that big movements in prices and rents are largely going to be a function of changes in demand, not supply. And the rental market, I think, is a really interesting microcosm, and it's, I think, one reason we focus on it is because it allows us to tease out developments that are not always obvious in other parts of the housing market. What we've seen on the population side is a very strong increase in demand, partly population driven in the regional areas, and that is where we've seen rents, advertised rents, most notably go up. In Sydney and Melbourne, in particular, in the apartment markets, we've seen rents go down, and that is in large part because our borders were closed and the typical influx of foreign students just basically dried up. So population growth over short periods of time, combined with some of the other factors Lucy mentioned, have had an impact and are one of the variables that we're always monitoring, of course.
So just to that point, I'm looking at a CoreLogic graph showing annual change in rents, combined capital cities. So what it essentially shows is after October 19, you saw apartment rents fall by 5% in 2020. And so far to October 21 of this year, you've seen them increase by 4.7%. And you've seen houses, consistent with your point, Dr. Lewis and Greg, you've seen house rentals increase by 9.7% over 2020, 2021. Does that not kind of indicate that we've got a supply issue that goes beyond population?
Well, the first point I'd make is that you're looking at the combined capital city number. And as Brad and I both indicated, the two biggest cities are the ones that have sort of lost population as a consequence of the closure of the borders. The rest of the country hasn't. So there's been a redistribution, and you won't see that in a combined capital city number.
So I should ask CoreLogic for Sydney and Melbourne.
Yeah.
Okay.
Yeah, well, I mean, I think did we actually have that in our oh, look, so we've got the advertised rents graph 14 in our submission, shows you that that the capital city rents, advertised rents in Sydney have basically bottomed out. And this just started to come back up again, similarly in Melbourne, whereas, you can see they were rising in the other states. So that's the advertised rents. That's not the experience rents. There are a lot of people who got a big rental discount last year, and at best they've gone back to where they were in 2019, or they may have held on to that discount. So if you look at the CPI measure of rents, that's also been relatively subdued in those cities.
I want to make it clear that my Canberra landlord didn't reduce my rents, but he's well known for being a hard ass. Anyway.
Well, you probably also weren't in a position to make a hardship claim for loss of income.
That's probably true too, or any hardship claim, what that might be. Okay. Also, in your initial public hearings, you said that you need to look at the housing market holistically. Do you want to give that more flavour?
Well, that's it may take me a while to paint a picture of a holistic system, but I think this is something the bank has been looking at for a very long time, and I personally have been looking at for a very long time. And one of the things that makes the housing market both so interesting and so complex is that it connects up to the finance system, which is the mechanism I described, and I was listening to your APRA's appearance, and there's a whole bunch of things around lending and lending standards and credit worthiness. There's a bunch of things around land supply and urban structure and architecture. There are just so many, and of course migration policy is relevant. There are so many touch points to the housing market, and if you look at one little bit in isolation, you'll miss the whole picture.
Right. Okay. Thank you. So. Are you worried that the low interest rates are fueling wealth inequality in Australia?
I think that's a legitimate concern. The way I would characterise it is an intergenerational issue, that people whose parents already have homes will be, the house doesn't disappear as each household no longer exists. And so, there's a mechanism by which the children of people who own homes can end up, relatively easily becoming homeowners. People whose parents rented are going to be in a much more difficult situation in order, to actually get into housing themselves. So there is absolutely an intergenerational component to this. And yeah, I would agree that that is something that is worthy of public consideration.
Okay. And indeed, you're aware that, further analysis of Thomas Piketty's data has indicated that most wealth inequality globally, but internally as well in most Western nations, has been driven by whether people own their home or not.
That is certainly an important element of it. And I think the issue is whether you're looking at inequality across the whole distribution versus top 1%. The top 1% story has got very little to do with housing. And I, again, it's sort of it does tend to be a natural consequence of just sort of, the random fate of generations and the random fate of different families. Walter Scheidl's work is also very relevant here. Housing is an important element of it. I mean, ultimately, though, what we're talking about is land prices. It's not so much about the structure that you're on, that you've built on that land. It's the fact that, all land is not created equal, and the supply of well-located land is really, is in some sense fixed, but is, in many senses dependent on, the transport infrastructure and what constitutes well-located.
So, in short, if you're concerned for all the reasons that we can explore for quite a period of time, with having a society that is equal and has equality, particularly when it comes to wealth, you need to encourage people, or you need to make it possible for people to be able to purchase their own home.
Well, I think, again, I mentioned it's the intergenerational issue, isn't it? It's the fact that some people will find it easier to purchase a home than others on account of the socioeconomic position they were born into.
Well, equally, we shouldn't visit the sins of our parents upon our children. So, and that goes in reverse too. So we should make sure that any Australian, regardless of where they're born and who they're born to, has, as far as possible, or as far as public policy allows, equal opportunity to own the home in which they live.
I can see that as being an attractive principle for public policy.
Thank you. Dr. Ellis, I will grab that statement because I know how hard it is for the Reserve Bank to opine on these things. Look, in your recent financial stability review, that you stated that house prices could fall sharply if rates rose in line with market expectations. What do you think? What does the RBA consider to be the impact on asset prices when tightening monetary policy?
This is something that we do think about. I mean, for very obvious reasons, we do not publish housing price forecasts. But thinking through the issues of the implications. So the role of the Financial Stability Review is to think about what could go wrong. So it's about thinking about the extreme scenarios. And of course, nowadays extreme scenarios turn out to be the ones that happen. Although on the output side, as we've seen, I mean, we've been pleasantly surprised about how wrong our forecasts were, particularly on growth and the ability of the labour market to recover from the pandemic. So yeah, I mean that is one thing that we're mindful of, and you reference again the conversation you had with APRA just before. Those sort of considerations are one of the reasons why you have an interest rate buffer required in a serviceability calculation. You don't want people to borrow. I mean, just to be very clear, most people do not borrow all the way up to what the banks will lend them. They don't tend to max out. Some people will, but most people will borrow a bit less than that.
Do you have data on that? Or?
Yes, and I don't think it's in the most recent Financial Stability Review, but that's something that the Financial Stability Department has certainly published material on in the last couple of years, yes.
Could I ask you to take that on notice?
Sure. Hopefully someone else is taking notes because I'm bad at taking notes and answering questions at the same time.
Very good at following up witnesses. Don't worry.
Well, that will be great. Yeah. So yeah, certainly our colleagues in the Financial Stability Department, do have information showing that most people, the maximum you're allowed to borrow sort of guides how much people are allowed to borrow, how much people will actually borrow. But most people do not actually borrow all the way up to their maximum, but some will, and that is why, when you're coming back to my opening remarks, that is why, in the main, if the maximum you're allowed to borrow increases a lot because interest rates are much lower and you can service a bigger mortgage on the same repayment, that will tend to bring everybody's actual loan size up, even if they're not maxing out to the minimum. But yeah, this is absolutely, that need to keep the housing sector and the household sector resilient to an increase in interest rates through the cycle is absolutely one of the reasons why you would have an interest buffer in your mortgage serviceability calculation.
So, Dr. Ellis, let me go to something directly before I hand over to the Deputy Chair. Australia's household sector is one of the most indebted in the world. So,
it has a similar level of debt to comparable countries such as Canada. I don't have the graph in front of me at the moment, but we are not an outlier. And once you allow for the fact that most investment properties in Australia, most rental properties are owned by other households, and so the debt that's held against them is household debt rather than corporate debt. It's where we are is quite explicable relative to other countries.
So that goes to my point, which is that we have one of the most indebted household sectors in the world, but it's leveraged against assets, typically superannuation and housing.
Yes, well, it's leveraged almost entirely on housing, and you may recall our submission to the Wallace inquiry. We did oppose
the Wallace inquiry in the late 90s. That inquiry?
No, the Murray inquiry. Sorry.
I'm
getting my submissions mixed up. So our submission to the Murray inquiry in 2014,
right.
we opposed leveraging into self-managed super. That wasn't a recommendation that was taken up. But yeah, so the point is, the debt is primarily against the housing stock, but I think an important nuance when you're looking at cross-country comparisons is the household debt in Australia is leveraged against the entire housing stock, whereas in many other countries, quite a lot of the rental housing is owned by pension funds, insurance, so the corporate sector, and so there's a bigger asset base in some sense behind that relative to some other countries. So that's just an important nuance. But yeah, so our household debt is comparable in the same ballpark as other countries, particularly once you make allowances for who owns the housing stock.
So a former Reserve Bank analyst writing in the Australian Financial Review said that his expectation is that house prices will fall 20% from their peak. That's going to cause systemic and economic-wide issues, isn't it?
I think a useful comparator to look at is, because we actually have seen this movie before in Perth. If you look at what happened to housing prices at the end of the mining boom in Perth and Darwin, it was painful. But I think you've got, again, this, the housing market is holistic. That's one of the reasons why, as my APRA colleagues discussed with you just earlier this morning, that's why people do stress tests about big falls in housing prices to think about how people would, would cope with that. And I think, again, it's important to understand what the context of that fall in housing prices is. If people still have jobs, that's a very different context to if people don't have jobs and their incomes have fallen and interest rates are higher. So, it depends a little bit on what else has happened. But I think a good a good example of what can happen, not necessarily what will happen, but what can happen is what happened in Perth and Darwin over the past decade.
Okay, Julie for 15, then Matt for 15, and I'll see if Jones wants to. I'll come back. Thank you, Dr. Ellis.
Thank you. And thank you for your submission and evidence. It's really interesting. Can I go back to the serviceability of loans being flat? Because again, it sounds counterintuitive. When you measure serviceability, is that just to people that have loans?
Well, that's correct. Yes, it's the So if you have a mortgage, that let me just, sorry, I'm just going to read the footnote on the graph of graph 5. It's the percentage. So the graph that we show in the submission is the percentage of median gross household income needed to service a variable rate mortgage with an 80% loan to valuation ratio for a median price dwelling. Now, I want to make clear the average, the typical first home buyer does not buy the median price dwelling. They buy a cheaper dwelling than that. So this is quite indicative. But if you look at that graph, you'll see that for the last decade, it's been pretty flat. It's come up a bit, house prices matter for that calculation. Interest rates matter for that calculation. But the combination of the two, mortgage serviceability is, lower than it was in the previous decade. So we've just shown, this century's data in that graph, but my recollection of the 90s is similar. That as rates have come down, there's a process. So this is really thinking about a mortgage that's just been taken out. Now, obviously, if you've got people, more people have got mortgages. There's more people paying that, so that the sum total of interest being, but the sum total of interest that's being paid by the household sector is reported in the national accounts at an aggregate level, and that that again is lower than it was back in the 80s and 90s.
Yeah, okay. And because APRA adjusts the serviceability requirement, then it's kind of a self-fulfilling prophecy, really, isn't it? That serviceability should be flat because it should be regulated to be flat.
Well, it's not regulated to be flat, but it's regulated to be resilient to increases in interest rates. The Reserve Bank has publicly welcomed the decision that APRA made to tighten that up.
Yeah, and in terms of the person on the median wage, in terms of a capacity to service the median mortgage, if you're on the median wage, is there measurement done on that?
Well, I mean, one thing we do know is a single person on the median wage is not buying the median house and borrowing the median mortgage. They're borrowing something less than that. And certainly once you go to total household income, of course, there's a whole bunch of people who own their home outright and are not paying any mortgage at all because they're older.
Yeah.
So, this is where distributional things matter a lot. But yeah, we do think about those things, and it's kind of hard. You can look at individual household experience, and in fact, my colleague John Simon and a former colleague Tali Stone have released a discussion paper a couple of years ago, thinking about the ability to the accumulation of the deposit is actually the binding constraint under those circumstances. Generally what we see is that most people, the majority of people actually pay off more off their mortgage than they're required to by the loan contract. And we've seen that happen quite a bit now. People have been socking away money in offset accounts and redraw accounts during this period, and particularly where you had lockdowns, some people were not spending as much as they ordinarily would, and a lot of that has been going into offset and redraw accounts, and is therefore effectively being paid. They're effectively paying more than they need to, and it's being paid away against their mortgage and their future servicing needs. So I think so. One important context here is, if and when rates do eventually rise, a lot of people will not actually need to raise their actual repayment because they're already paying more than they need to according to their loan contract. And that is actually one of the desirable features of the Australian institutional framework that a lot of other countries don't have. Other countries do not have the widespread use of offset and redraw accounts, which are the most tax-effective form of precautionary saving ever invented.
Statement you made before that the median wage is not buying the median house. Is there any longitudinal study over where in the range of house prices the median wage was over time?
I can't think of a study like that off the top of my head. I'm happy to take that one on notice. It would be possible to do analysis. It may be that someone else has done the analysis of, tracing that through. Like you could use the Hilda survey for that, for example, but I don't think we've done a paper like that.
Thank you. Thank you very much. Can we talk about rental? Because rental is really interesting in Australia. I mean, in Paris, you can't get a lease for less than 6 years. Here, you can sometimes can't even get 6 months. And I know that real estate agents make their money on the churn, but are there any other factors going on in Australia that prevent us from providing what a lot of people want, which is long-term stable rental in the commercial market.
Yeah, and having lived in Switzerland, you know, it is just a very different mindset in the rental market here. I mean, you know, people never talk about, you know, people always say they own an investment property. They don't say, I am a landlord, or I have a little side business providing house services to my customers. You know, my landlord in Switzerland actually once said to me that he thought of his tenants as his clients, and I nearly fell over because I can't imagine any landlord in Australia saying that. So there is a different mindset. That, you know, it is a different rental structure. We did talk about this in our 2003 submission to the Productivity Commission inquiry on first home ownership and affordability. That, you know, there does seem to be something a little bit different about the way the rental market works here. One of the things that happens is that people can rent out, you've got a lot of control over the home. So if you want to move back into that house, you can kick the tenant out, kind of sort of no, it's like a kind of a no fault. If you want to move in, you can kick them out again. There is a tendency to have quite short-term leases. Now that works for a lot of people, but I have spoken about this publicly before. I gave a speech in early 2017 about where I showed a graph of how often people move, and renters do move more often than homeowners, and that is probably not in someone who's young and maybe wants to move around for different jobs, that's that provides some flexibility. The fact that you can rent out your own home, go and work somewhere else and rent there, and then come back to your own home instead of like selling and selling, buying and then buying and selling again. I think that does add some flexibility, but absolutely there are swings and roundabouts to that. It's not as we've said publicly before, it is not, but a long time ago, it's not an institutional configuration that gives you long-term rental and long-term rental contracts. But yeah, again, if you think about the countries where you do have stable long-term rental, you also have relatively low rates of home ownership, because, I know people, like friends of mine, who said, I got sick of moving every year, so I finally bought a place, even though it was, maybe, not the ideal place, but I bought somewhere because I was just sick of, the lease expiring and having to move again.
Yeah, and I'll talk about that too, the byproduct of housing, because housing actually isn't the point. It's the bath, if you like. It's the baby, is the stability and the financial certainty and all the rest that it gives you over time. And Australia is a really innovative group of people. We're really early adopters. We come up with great ideas. And even though there's this massive group of people out there that are not served by the current housing market, we don't seem to have come up with a whole stack of sub-markets of land trusts and co-ops and shared equity and institutional investors. Do you have any idea why that is? Is there something that stops us from finding or creating other markets for the answer?
Well, one of the things that I'm very mindful of is, and we've spoken about publicly before, is that the tax treatment of investor property, while it is the same as the tax treatment of other income producing assets, because you can leverage it, the combination of negative gearing with concessional capital gains means that it is very attractive to leverage into into investor property, as opposed to thinking of yourself as a landlord with a business providing housing services. And so as a consequence, individual households do it, whereas in other countries, and so what happens is the rental yield on rental properties in Australia is quite low. So the overall level of rents is quite low, is low relative to prices. And I mean, but that's the thing is, because of the tax advantages, individual households investing in rental property are willing to accept a relatively low yield for that. It's still attractive relative to other investments, but they're willing to accept a relatively low yield. But because a corporate doesn't negatively gear, and because they're not necessarily planning to sell it later on, it's a long-term investment for them. The concessional capital gains is less relevant to them. And so I'm not even sure that even works in a corporate environment. My knowledge of corporate tax law is close to zero. But essentially, what it means is that a household owning an individual house to rent out is willing to accept a lower yield than a corporate would. And I mean, I remember ahead of our 2003 submission to the Productivity Commission inquiry, Rick Battolino and I actually went on a bit of a study tour to a whole lot of other countries, and we're talking to them about the rental market. And one of the questions we got asked was, how on earth does it work having all these individual landlords? Because, in our country, and this is particularly a story in the US, it's like, well, how do you get the economies of scale of managing the properties? And it's like, well, we have real estate agents for that. But so, the sort of, they were very mindful of those sort of costs, and a corporate landlord just doesn't seem to be able to run a whole bunch of, pockets of apartments here and a couple of houses there. Just the cost of managing that as a corporate landowner is quite high, and so they would want a higher rental yield. So quite frankly, the individual property investors are outbidding, would outbid them because they're willing to accept a lower yield.
Thank you. Can I ask a question about data? We've been hearing from a range of witnesses that there's data that just doesn't exist, where the land is, when it's coming online, where, a whole range of data that just doesn't exist. Is there data that you want that you can't get?
Julie, Julie, that'll have to be your second last question. Sorry.
That is my last question.
Is there data that I want that I don't have? I mean, I think that's true for pretty much every domain. More data is always better. It's fair to say, I mean, we're not necessarily looking at like small area land supply issues. I mean, that's well outside our remit. But I can imagine for agencies and other actors in the housing finance system who for whom that's really relevant, about planning for infrastructure and planning for where to develop things, and thinking about, I mean, the population moves that we've seen because of COVID have just been completely different to what we were seeing over the previous 10 years. And so, yes, having information, I imagine that would be very valuable to people.
Thank you, Jason. That's it. I'm going offline.
Thank you, Julie. Jed, do you want to answer? Sorry, Jed, do you want to ask your question now?
It's noisy. I'm in pouring rain in the car. To the extent that we've talked about demand, I have a couple of questions. How, and we've talked about local levers and concentrated very much on all of our regulatory bodies and frameworks in Australia. To what extent is the Australian housing market linked to international issues? There was, for example, an article in the ABC recently that is opining about the possibility of interest rates rising or inflation rising and therefore interest rates rising in the US, how that will have an impact on banks in Australia who rely on financial institutions in the US. It might put up the cost of borrowing in Australia and have a flow-on effect there. So I'm interested in your view about that and how reactive our housing market is to international or global influences like that. And number two, you mentioned in your submission that other countries, again going on this global issue, have sought to improve the balance between supply and demand by restricting demand. Are there any particularly successful countries or anyone that's done that very well? And are there lessons that we can learn here? Thanks, Lucy.
Well, thanks very much, Jed. So on your first question, I think that I would make a distinction between the multi-decade trend and the cycle. So the multi-decade reduction in interest rates and the move to a low inflation world was a global phenomenon, so the overall level of inflation, that was something that was in our interest to follow with. The overall level of real interest rates, so inflation-adjusted interest rates over multi-decades, is more or less driven by global trends. And the governor has talked about this in some of his parliamentary testimony in the past. But there can be quite a lot of dispersion in the cycle. If you look at the history of interest rates in the US versus here in Australia, there is quite a lot of differentiation because our macroeconomic experience through the cycle and our inflation experience is not necessarily the same. And certainly at our current juncture, we do not. If I'd refer you to the overview of the statement on monetary policy where we step through this a bit. We're not quite in the same situation as the US in terms of the inflation pressures. We're seeing some of it, but to a lesser extent. So, there's no necessary linkage between what the Fed does and then, there's no requirement for us to then move step for step with that. There's obviously a correlation over a longer horizon between interest rates in different economies because there are global, factors at play. But inflation rates and interest rates over a shorter horizon do differ. And so I wouldn't necessarily say that what happens in the US necessarily happens here. And then on your other question about, are there examples of countries that have done well constraining demand? And I think, look, the jury is out. I wouldn't want to point to any particular country saying, well, this was a good intervention. But one that we are watching to see, how it plays out over the next little while is New Zealand, where, they went from a situation where their tax system was even more generous to investor property than ours. For a long time, they didn't even have a capital gains tax. Their negative gearing was also quite generous, and they've tightened up on that a lot recently. And it'll take a few years. That's happened very recently, and it'll take a few years to see, the washout from COVID. The population flows that they've experienced as a consequence of closing their borders have been a bit different to ours. They had a big surge of population as all the Kiwis came home, whereas we've had a reduction in our population growth because the flow of, it was more about, the flow of foreign residents coming to become Australian residents being tapped off. So, there are examples. But is there a situation where is there a case where I could point to say, oh, this was a really good example where we stopped people demanding so much? I mean, looking at the US, where their housing prices have risen at least as much, if not more, as ours in over the past year, including in some of the areas that were previously considered to be quite flexible, like the cities in Texas. And what we found, but they were doing very much the wrong thing in terms of encouraging people to borrow more prior to the global financial crisis. And so the fact that they have tightened up on that more recently, that housing prices have actually had a bit more of a lid on them, but it's hard to know how much of that was because the fallout of what happened before versus the consequences of coming back to a more rational level of demand and availability of finance compared to where they were in 06, 07.
Jed, are you happy with this being your last question?
Yeah, thank you.
I mean, the next one. Do you have another question?
No, that's all. Thanks, Jason.
Thank you. Matt for 15. Thank you.
Thanks, Chair. Thanks, Lucy and Brad, for your evidence. Just following on from Jed's question, are you a little bit concerned that you're starting to see increases in fixed rates here in Australia at the moment on the back of those inflation figures in the United States? Obviously, I think that's got something to do with the cost of raising capital by the banks in international markets. But we're starting to see that coming into the Australian market already, despite the fact that the RBA said that you can't foresee domestic interest rates increasing for at least 12 months.
Thanks for the question. The fixed rates that are rising are for a longer horizon than 12 months. And it's also important to remember that the majority of mortgages in Australia are still priced off variable rates, so they're floating rate debt. Swap rates, so the banks tend to price their fixed rate loans off swap rates. And so as swap rates have risen, yes, you've seen that in the sort of the new fixed rate loans that are available. But I mean, people can make a choice, that isn't affecting the people who've already taken out a loan. It's only the new fixed rate loans. So people have a choice between variable rate loans and fixed rate loans. And so people make choices about which they go for, depending on their, their comfort levels with, what could happen with different, different paths for interest rates. I mean, certainly, swap rates embody the market participants' expectations about interest rates out several years, and we have a different view based on our view of the future, and that's okay. But a 1 year fixed rate has not really risen. It's the sort of 3+ year fixed rates that have risen, and that's making a statement about 2024, 2025.
But on that point, the 4 or 5 year fixed rates that people were able to secure even 6 months ago were remarkably lower than they are at the moment. And commentators are saying that that's starting to price in inflation in the US, but also rates rising more quickly than you forecast. You have a view on that?
Well, I'm not going to comment about the future path of monetary policy in this context, but yes, obviously, market rates embody market expectations of what we're going to do.
Okay. On the serviceability issue, there was some commentary earlier about the potential for the asset values to start to fall in Australia. And when people talk about serviceability, they're often discussing the ability to make the repayments. But there's also an issue with the asset value, isn't there? That if a fall in the asset value affects the loan to valuation ratio, then a lot of people could be in a lot of trouble. And the thing I find is that most Australians don't understand that a bank can ask you to pay off quite a hefty amount in one go if there's a fall in the asset value, or even in some circumstances, take the home back. Is that something that you think that government, or indeed APRA or yourselves, should be alerting Australians to, that it's not just about paying off the loan, it's the value of the asset as well?
Thank you for the question, because it does allow me to put on the record that, to my knowledge, mortgages in Australia do not have those kind of call-in or sort of loan, LVR, loan to valuation ratio covenants that commercial mortgages would. So the covenants, the loan covenants that you've just described, are sometimes a feature of loans to corporates, but I am not aware of home mortgages having those features and having those contract clauses. It is relevant. Thinking about the amount of equity you have in your home is important if you do get into trouble and can't service your loan, because then if you can't, you need to sell it, and you're left with sort of no equity. You walk away with no cash on the table. So it's important, if you do get into trouble, it's better to be able to sell and have something left over that you can then get started again and get back in at a later stage, than if you have no equity and therefore you're left with nothing. But I'm not aware of any situation, and I would not regard it as being sort of self-interested behaviour on the part of the lender to call in a loan on a household who is servicing the mortgage adequately. If someone was not servicing the loan, then there's an issue of default, and you have to take them to court to get the property, by the way. But I am not aware of any mortgage. Now, it may be that there's someone's writing this into the clause, but I would not regard it as being, I would not regard it as being common. In fact, I'm aware of no examples where a home mortgage for your own home involves a call-in clause or a put up more equity clause. It's not a margin loan the way you would have with shares. So yeah, margin loans on shares do have that characteristic and do have those clauses. I am not aware of mortgages having that clause. But in terms of your statement that households don't understand this, I think they implicitly they do, because most households are paying off more off their mortgage than they need to. Most people, the majority of people, and when rates fall, they tend to maintain the repayment, and so they end up amortising their debt faster than the contract requires. And the majority of households, end up paying more. They're ahead of schedule on their mortgage, and I would regard that as an a positive feature of the Australian market that is not seen overseas to the same extent because of the role of offset and redraw accounts. I think it's showing that households do want to have that buffer. They don't want to lose their home.
Maybe just worth adding there, the bank, in particular the Financial Stability Department, has done a lot of work at a cross-sectional level, looking at the range of Australian households who have both high levels of debt and low prepayment buffers. And the way that we've tended to think about this, if there's a vulnerability, it's households that are very vulnerable to an income shock. That's the channel of sort of vulnerability rather than an LVR ratio at a certain number. And in the latest financial stability report, the team there have done a fair amount of work to see how has that nexus of borrowers who have a lot of debt and low prepayment buffers, how has that changed over the course of the pandemic? And the numbers are suggesting that share of what we would call the most vulnerable borrowers has actually gone down. It's gone down a little bit over the course of the pandemic. Part of that's because, of course, because of lower interest rates. But if you're thinking about sort of vulnerabilities, it's an income shock hitting those households that have got low prepayment buffers and that are carrying a lot of debt. That's where we think the vulnerability would be more so than an LVR at a certain level.
I'll move on. I might come back to that because I'm just going to run out of time, I think. But in your submission on page 14, you point out that the way the system works in Australia, it's made it favourable to own additional properties as an investment asset. Is that an efficient system? If the number of people that can own one property is falling, a system that incentivises people owning additional properties wouldn't seem to be the most efficient way to allocate resources, would it?
I think that is a conclusion that some may wish to draw. It is the system we have, and the question is, can you get from here to there?
And you go on to say that two potential objectives of reform could be to incentivise more efficient utilisation of some of the existing stock of housing. Can you elaborate on that? What do you mean by that?
Well, there's a number of different elements of that. So one of the things about the way our system works is that if you have, if you own your own home at the point you retire, that's basically the thing you need to do to not be in poverty in retirement. And our retirement finance system is predicated on that, and the way the asset test, the insulation of the own home from the means test and asset test on the age pension is all bound up in that. The way different age groups are taxed is all bound up in that. But there is a certain level of inefficient self-insurance. People are worried that many older people are worried that they will not be able to afford aged care if they need it. Now, not all of them will need it, but a lot of people are holding on to more house than they can manage because they know they need that asset base in case they end up in aged care. And as a consequence of that, you've got a lot of people in homes that are perhaps a bit too big for them now, that they're struggling to manage. And but the alternative is downsizing. Downsizing isn't always easy into appropriate housing, and you end up with sort of money you've extracted. You downsize into a cheaper, smaller property. You've now got assets. Well, now they're subject to the asset test and the means test. So people may feel that it's not in their interest to self-insure for aged care in that way. So that's one example. But I think another example, I spoke in reference to another question about, there are swings and roundabouts to our rental market and that people have to move very frequently and so forth. But the fact that, anyone can become a landlord does mean that, if you do want to move for a job, but you don't think you're going to stay in that other place permanently, you can, rent out your home, go and rent somewhere else for a while, come back, move into your old home. That's a flexibility that many other countries don't have in their system. but there are inefficient, but you do end up with some inefficiencies around, people feeling like they can, sell and buy and sell and buy because of the cost of transacting. Stamp duty is part of that, but it's not the only part. In other countries where stamp duty is lower, you generally find that the transaction cost is just as high, but it goes to the real estate agent, not to the state government.
Is there any evidence that more Australians are reaching retirement age and they still have a mortgage?
There's some evidence that some people are using retirement lump sums to kind of finish off the mortgage, but it's usually small amounts. The Reserve Bank has not, to my knowledge, done any specific analysis of that, and it may be that some academic work has looked at that specifically, but in general, so that there is a certain element of people sort of, paying off the last bit of mortgage with the superannuation lump sum. That does happen. I am aware that the other regulators don't regard that as being a particularly appropriate provision to finance. That lenders shouldn't presume that households will do that in what So in terms of calculating how much you'll lend, you shouldn't say, oh well, don't worry, they've got all this super and we can just take all their super. That's not an appropriate way to think about it. But people do. We know that through the early 2000s, for example, that part of the increase in the debt to income ratio was that people in their sort of 50s were more likely to still have a mortgage, but it was usually pretty small. So there was kind of like an inframarginal increase in debt.
And just going back to that earlier point that I made about the asset value and serviceability, is that a recent change, that the lack of covenants in mortgage-based loans, such as the one that I was discussing? Does that apply to interest-only loans as well? And I was under the impression that not the most recent round of APRA tightening, but the one before did result in people holding interest-only loans having to look to pay off some lump sums because the value of the assets had fallen.
Okay, there are two things going on here. So in answer to the first bit of your question, I am not aware that it has ever been, I could be wrong, but I am not aware that it has ever been a feature of the Australian mortgage market that banks could just call in a loan that was still being serviced according to the contract. And I do not believe that it would be in their interests, their own financial interest, to call such a loan. In terms of the phenomenon you're describing, when APRA tightened certain criteria on interest-only loans, the result was that the interest rates on interest-only loans in the back book also increased. And so some people decided that maybe they didn't want to pay that higher interest rate after all, and so they wanted to refinance. So it wasn't that they were required to stump up some more capital in the existing loan. It was just that in order to refinance, they were now facing tighter lending conditions, and it was therefore in their interest to stump up some more capital in order to get a principal and interest loan. They needed to kind of qualify for it. Obviously, if the value of the property had fallen, then you would, you wouldn't get as big a loan for that. So you end up having to put in more capital. But that's really in the consequences of someone's decision to refinance rather than pay the higher interest rate that was now on offer. It was not the case that people who were continuing with their existing interest-only loan were being asked to stump up some more capital. It was only because in order to refinance, you are now facing tighter lending conditions than those that prevailed when you first took out the loan.
Great, thank you.
Thank you, Matt. Dr. Ellis, earlier in your evidence, you said that you said a low inflationary environment results in asset prices increasing at faster than CPI. Have I misstated your view or the view of the bank?
The way it works is that when inflation is lower and nominal interest rates are lower, you are discounting the sort of the benefits or the income flow of an asset with a lower discount rate, and so the equilibrium level of asset prices is different. It's now higher, and there's a process of transition from, the old equilibrium to the new equilibrium, during which asset prices will rise more quickly. But it's not a, it's not a permanent state of, it's a move from one steady state to another. It's not a move, it's not a permanent change in the growth rate.
But wouldn't it be good if we could have the best of both worlds, low inflation and asset price inflation at the same level?
In the long run, that's actually what you would expect. But when you have rates ratchet down, so, the big narrative, there was the big move in interest rates because of lower inflation and financial deregulation. And that sort of process ended in about 2005. There's been another ratchet down in the equilibrium real interest rate globally. So what people sometimes call R*. And there's a number of different possible reasons why that has occurred, but it's a global phenomenon. And so then you've had another transition because of that. And then, of course, at the moment, because of COVID and the policy response to COVID, that was quite properly put in place, rates are lower again. And so you've had periods of ratchet. I mean, if you actually look at house price growth in Australia through this period, there were a number of periods, including say 2003, 2004, or sort of the very end of 2003 and into 2004 and 2005, where actually housing price growth didn't outpace income growth or didn't outpace price growth. But yeah, so, I mean, it's been kind of like a bit of a stair step of these equilibrium shifts. But what we're describing is an equilibrium shift to a new sort of equilibrium level of prices because you're now discounting at a lower interest rate.
Also, you mentioned New Zealand's policy response earlier, but did I miss that you also talked about some of their supply changes, some of their policies designed to allow for much faster and greater supply?
They have had even more issue. I'm not an expert in the supply side piece of the New Zealand policy response. I know they recognise it as an issue. I think one of the reasons that they recognise it as an issue is that they face even more of a geographical constraint than us, because we have a 45% of our population. What is it? 45% of our urban population. I forget which now. But we've got a lot of our population concentrated in 2 cities, and one of those cities is basically encircled on 4 sides by ocean and mountains and national park. So there's inherent sort of supply. You just can't keep going out. Whereas in Melbourne you can. I'm actually in the Melbourne office at the moment, and there is a lot more of Melbourne on the in the southwest side moving out to Geelong than there used to be when I grew up here. So your ability to expand depends on your geography. And in New Zealand, a very large fraction of their population is in 1 city, not 2. And that city is really, really hemmed in. If you look at, a map of Auckland, it's extremely hemmed in. You see a similar phenomenon in other countries where you've really only got 1 big city that's hemmed in. Like, for example, Santiago in Chile is hemmed in by mountains. The Andes are on one side, but there's all these sort of foothills of the Andes that you can't easily build on the other. So they've gone up a lot. So they've really densified because they have no other choice. But housing in Santiago is very expensive relative to the rest of Chile. And you talk to our Chilean counterparts, and they will tell you they face a huge housing affordability issue. But it's kind of, there's no alternative to living in Santiago if you want to live in a big city and have all the the jobs and amenities that are involved in living in a big city. But there's nowhere further to go. And if you've ever driven around Santiago, it's it's just crazy.
Well, I would love to have Chilean counterparts, but I don't. So I'll take your word for it. I guess my underlying and essential point is that New Zealand's response recently, so I think 3 years ago, they announced that they were going to allow people to build 3-story buildings in Auckland, which is what you referred to. And they recently announced that policy for the entire country. And it was based on the fact that they have a region called Selwyn. And Selwyn, about 11 years ago, decided that they were actually going to get rid of most of their planning controls, or if I can put it differently, have very light touch planning controls. And what they saw was that as demand came into the market, they saw that most of that demand got channeled into increasing supply and very little into price increase, Whereas in Auckland, where the planning control stayed in place, most of the demand got channeled into higher prices because there wasn't a supply response. That's pretty consistent with market economics, isn't it?
I mean, the evidence on this really depends on, what your geographic constraints are. And so the question is, if that's been the case in that district, I mean, there are plenty of cities that are cheap to buy in various countries because people are moving out and there's, plenty of empty properties and low demand. And that's how you get cheap property. In terms of, if you have people moving into a place, so you need to build more housing to accommodate that additional population. Realistically, the way, whether you can manage to do that, how you configure your supply, your zoning laws and your planning permission and so on does matter for how much of that, shows up as, additional housing versus additional prices. But I think, the lesson I draw from looking at, more than one district in New Zealand and across the world is, geographical constraints are sort of more fundamental. And whether you will see, I mean, you just said, oh, well, they can now build 3-story buildings. Well, I mean, Sydney has much more liberal laws than allowing you to build 3 stories. And where there are restrictions, quite a lot of it is around safety. So there's issues around, spacing between different houses, for fire reasons. There's issues about what materials you use, again, for fire safety and insulation reasons. And there's issues around, well, yes, you can build a 3 or 4 story, home, but only if it doesn't overlook your neighbour's garden. And that, I think, is a reasonable accommodation for us all to live in society. So what you've described as the relaxation in Auckland sounds like still very restrictive relative to what we have in the cities in Australia. And so, actually another good example, I think, that would be more comparable is that back in the 90s in Victoria, they instituted dual occupancy. And so as long as you could meet building code, you could basically put 2 dwellings on a suburban block. And I can tell you that the part of Melbourne that I grew up in, most of the houses that were there when I was growing up are not there anymore. There's now 2 or even 3 smaller homes. And so there's been a considerable densification of housing in those areas. It is not obvious that made a big difference to the sort of the level of housing prices. Melbourne is cheaper than Sydney, but it's not obvious that was a big, a big liberalisation, but it's not obvious it made a huge difference because, there was common demand factors as well.
And sorry,
Brad.
Just to chime in, I think on the New Zealand piece, it's interesting because it connects back to, I think, a point we try to convey in the submission, which is that we really need to be looking at both supply and demand here in terms of solutions. And what New Zealand's tried to do, my understanding at least, is in addition to a partial relaxation of some of the planning laws that you referred to, they've also set up a new infrastructure fund to help accelerate new housing supply. And on top of that, they're basically phasing out the interest deductibility as it pertains to investment properties for established dwellings, but they're keeping it for new dwellings. And so they're looking at this quite holistically, I think, and that's maybe something that will be of interest for some policymakers here. It's too early to say how this all plays out, of course.
Sure. And so Dr. Jones, I'm just going to pick you up on that. So one of my concerns about the RBA submission is that you talk about demand and supply. And just to be clear, when we talk about reducing demand, we are talking about people who are trying to buy their homes, buy a home to live in.
Perhaps I should take that one up. I mean, I think what we're pointing out is the difficult trade-off. And as we said in our 2015 submission, there are no examples internationally of large falls in nominal housing prices that have occurred other than through significant reduction in capacity to pay, such as a recession and high unemployment. You can do it, but it's not something you may want to do. And there's no example in Australia or internationally where supply expansion on its own generated house pricing declines of a similar order of magnitude to the kinds of cycles in house prices that we've seen in Australia in recent years. And
Dr. Ellis,
yes, you could achieve what you could achieve a big decline in housing prices, but you may not wish to do so precisely because of the trade-off that you're referring to. I think we're in furious agreement here.
Yeah. So I get enough economics to know that price is a function of the interaction between supply and demand.
Yep.
And we have a choice here between expanding supply or reducing demand.
Yep.
Or doing both, a bit of both. But the implications of reducing demand are, and I think we need to be clear about this, is that we're telling some Australians that we don't want them to own their own home, or we don't want them to own a home, because that's how we're going to moderate prices.
So the way we've characterised it in our various submissions is really more a cautionary note to say you don't improve affordability by giving people even more money to then bid up prices. And so, in thinking about things like the various subsidies that we've seen recently, some of those did add to demand. That is one of the factors that has been relevant. So I think, the important point, we're not, the Reserve Bank is not in the business of saying, wouldn't it be nice if demand were lower? That is not what we're saying. And, we've been quite clear that, we're saying, it might, wouldn't it be nice if, everybody could afford, a really, really big house and not have to pay very much for it. But we don't think that that is feasible given, the availability of finance, given the geographic constraints, given the cost of construction, and given the fact that well-located land is actually in limited supply. You can build a really cheap house somewhere out where you don't want to live, but in terms of thinking about where the jobs are and where the amenities are, that, in the end, so I think one of the things I want to round off on, and because I'm conscious we're coming up to time.
Well, I was going to ask Dr. Ellis and Dr. Jones, are you pressed, or could we extend the hearing for?
I have a 4 o'clock flight, so I'm somewhat limited, and Tullamarine a reasonable distance from the Melbourne office, but and there are no later flights, so I can't afford to miss it.
Well, in that case, we'll extend it for another 15, and I'll start to interrupt more often. My apologies.
Okay. Yeah. So I think the point is that the supply that we're talking about is the supply of well-located land.
Yes,
and
I'm
you
not
can
talking
add
about
more.
that. Yeah, and I think the Reserve Bank keeps conflating that, wouldn't it be nice if everyone lived in a mansion by the harbour? And I don't think that's what this committee or this parliament is talking about. And indeed, not everyone does want to live in a big house. Every second weekend when I mow the lawns, I think, wouldn't it be nice to live in an apartment? These are choices we make, but these are choices that are best made by us personally, not by some centrally planned authority. Wouldn't that be fair?
I would concur that and I have stated publicly in past speeches that it would be good to have a range of housing options for different people's life stages and needs. When I say the supply of well-located land, I don't necessarily mean a mansion by the harbour. I mean homes that are close to jobs and homes that are close to the amenities of a big city. You can go in
some of the cities that you mentioned before in Texas in the United States that have very light planning laws that are not centrally planned have actually organically designed cities much, much better at ensuring people live closer to where they work and having well-located land than all the centrally planned cities throughout the world. Wouldn't that be fair?
I would make a distinction between cities that can grow on all sides because they're inland and cities that cannot because they have coasts. And in many respects, the restrictions on supply, on sort of building codes and so on, they're not necessarily because people are trying to design a particular kind of city or enforce a particular kind of building. I mean, some of these places do have rules.
Yeah. Sorry.
But
They are
the
in Australia
important
because
point-
we've had evidence from the Planning Institute of Australia, and it's their evidence and they're fully entitled to it, which is they don't just want to tell you where to build, they want to tell you what to build, and then they want to tell you what it looks like and how it works inside. And indeed, they went as far as saying Australians have too many rooms in their houses and we need to design smaller houses.
I think there are certainly people who would benefit from being able to access a smaller home because a smaller home that is cheaper to build would be more affordable. So, if we're continually building big 5-bedroom places, well, that's not going to be accessible to people who are on low incomes.
But we're doing that currently under some of the most centrally planned housing markets in the world. I mean, why don't we try doing what we do in every other marketplace, which is let suppliers meet buyers and they can decide. And they'll get it wrong. They'll get it absolutely wrong. Docklands is an example of where they got it wrong. Doesn't that make sense?
I'll make a couple of points in relation to that. One is that housing prices in those cities in Texas, have actually risen in the last year or so, as at least as quickly as all the coastal cities in the US.
Yes.
So it's not a.
Which I would remind you of your earlier point that we shouldn't conflate longer term price rises with short term.
Correct. So yes, I mean, absolutely. If we were living in inland cities, with all the things that you're talking about are about the restrictions on how you build a home are in the cost of the dwelling. So they would be captured in construction costs. And I would refer you to some of the work that's been done by former colleagues on, the effect of zoning, and that gets captured in, to the extent that that's properly measured, and there are many different views on that. The cost of the land is what we're talking about. It is the price of well-located land, which is more or less fixed unless you change transport infrastructure or unless you, rebuild Warrnambool to be a city of 1 million people. The supply of well-located land is relatively fixed in the short term. And so, for that reason, if the Planning Institute is saying we want you to do all these things that are increasing the cost of construction, well, that will be captured in the cost of construction.
No, sorry. I guess what I'm saying is that I actually think, so for example, the mindset that says we want 1 million people to live here and so then we just go about rezoning land and, build it and we assume the people will come. Why don't we just leave our housing market to how we leave every other market in Australia? I mean, that's not to say unregulated, but it is to say the regulation should allow buyers and sellers to meet in the marketplace and decide what they want, where they want, and how they want it.
I think it's an interesting proposition. And I think, the important point I would make about the housing market is that, houses are not mandarins. There are, the land underneath them is very important. You don't buy mandarins with a 25-year mortgage. Accumulated interest is not a consideration when you're buying mandarins, and the mandarins you buy this week are new mandarins, and they're not the mandarins that someone that you didn't buy last week. The mandarins last week are no longer available for sale because someone's eaten them, probably my children. And so, it's the laws of economics do depend on the sort of the fundamentals on land is.
Okay, I have to stop you there because we've heard this mandarin, occasionally banana argument. I guess it's choose your fruit. And you've revealed your bias in your children's fruit eating habits. But
no, I was referencing the fact that you used mandarins in your previous discussion with APRA.
Fair enough. So I've revealed my bias. I guess though, I mean, the housing market is not the most complex market in the world, is it? I mean,
it has complexities that are not
complex than this.
Yeah, it has complexities because we're talking about the market for land. We're talking about structures that stay there after you've built them. You're talking about the role of finance, and you're talking about very differential margins of the quality of the property versus the versus the number of properties. And all of those things do add a complete, it's a very well understood market, and the vast majority of the academic, and our colleagues in the Bank of England, they will say, yes, there's an element to which supply restrictions do matter, and in particular, and we've said this publicly in the past, supply restrictions do matter, and they certainly matter in terms of the balance between price growth and additional properties when you're facing an increase in the demand in the form of increased population in a particular area. That's, none of that is disputed, but, the primary thing that's going on in this is, the interaction of incomes and interest rates that happen, over many decades, and that's also not in dispute. If you talk, if you talk to our colleagues at the Bank of England, I mean, they certainly say, the increase in prices in the UK and in many other markets is almost entirely explicable by over those decades by the decline in nominal interest rates. Now, absolutely within that, there will be cities that are cheap and cities that are expensive. And you mentioned Texas, but there's also plenty of the cheapest properties in the US in terms of the cities where the house price to income ratio is the lowest are not in Texas. They're in Ohio, they're Cleveland, Cincinnati, Toledo, Dayton. These are they're not in Texas. So actually, I think that's another example of where yes, supply does matter. But what really matters is if you're in a local economy that's doing badly, where incomes are low and where people are moving away, you can buy a cheap house.
Sure, but there's also the element, for example, of Tokyo, where after the 1989 crash, they instituted a massive fiscal stimulus that included what we call social housing here. That didn't shift homelessness, home ownership, housing prices. But what did was planning reform by the Tokyo government in 2004. And that was highlighted in The Economist only last year, wasn't it?
Look, the Tokyo market is a very different market, and
but so's the UK market compared to Australia.
I think there is a real difference in, again, two things that are quite important. One is we have a growing population, they have a declining population. That is really important in terms of thinking about the balance of supply and demand, and I think that shouldn't be underestimated. And I think the other point is that almost everybody in Tokyo proper would be living in apartments, and so the sort of the land component of that is quite small, and so it's just a very different configuration.
So let me.
Yeah, go on.
Sorry, let me quote Governor Stevens, who wrote former Governor Stevens, who wrote a report to the New South Wales government. In that, he said, we need to have on housing affordability. He said we need to have the supply side able to respond to demand in a more elastic way. The length of time taken for rezoning and development approval is much too long. This lowers the short to medium term elasticity of supply and raises long run costs. Do you disagree with that proposition?
I agree with that proposition.
Okay.
I just think that there's a limit to, that will be helpful, but it doesn't undo. So I would refer you back to my opening statement. There is a benefit to reducing general inefficiencies in the planning process. But I would also highlight that that's not a panacea that will undo everything that's happened over the last 40 years of lower interest rates.
Sure. And indeed, the planning reform in Tokyo, for example, and Tokyo as a city is continuing to have population growth as people empty out of country towns, or what they call country towns. But it moderated prices. It didn't reduce them. But in 2018, the RBA issued a paper that basically said supply for housing development had a major impact on physical input costs of between 42 and 73% for Australia's major capital cities, 73% in Sydney and 54% in Perth. This, and it further went on to say, look, the capital gains tax concession and negative gearing has an impact on prices of between 1% and 4%, depending on what markets you are in. Shouldn't we be focused on the factors that are driving up prices by, 10, 15 times of what the tax side is doing?
You've asked me about that paper before. Any one research paper is one perspective. It's not the whole story. And I think, it's an estimate based on, a particular methodology and a particular model. And I'm aware of other research that's been released since by others that, there have been a number of cities in Australia where actually you would expect, you would expect to see a result from, because there has been a significant liberalisation in planning laws, across the eastern seaboard. I mean, I don't dispute that there has. I mean, in Brisbane, there have been a number of changes. That the fact that again, this is not detail that I've tracked in detail, but there have been a number of planning reforms in New South Wales, which is one of the reasons why we have so many more apartments than we used to. Like
the planning reform
15 years ago.
So last time you appeared before us, you said you made that statement about apartments in New South Wales. So I went and dug into the figures about that. And it turns out that the vast majority of those apartments in the inner city part of it occurred in Green Square. Green Square was developed under Frank Sartor when he was planning minister, and he removed planning control from the city of Sydney and basically approved those apartments by fiat. You talk to every build. I mean, you walk into any corner pet store in Sydney and talk to the local building galah, and he'll tell you that planning laws in New South Wales over the last 10 to 15 years have become, more constrictive, more laborious, more complicated, more expensive to administer. And frankly speaking, and we heard from NIFIC this morning, no one's actually certain what the rules are anymore, much less what the charges are.
Thank you. We do not hear the same story from our liaison contacts. There have been some liberalisations to New South Wales law, but I think, that is not something that fits within our remit. Can I just, I'm conscious of time. I do have a plane to catch.
Yes.
But, one of the things, the point you make, and we did make this point in the submission, that, part of the issue is not that the rules are restrictive, but that the rules are uncertain. And so it may suit some builders that the rules are uncertain, and maybe if you've got the balance sheet strength to sit around and fight it in the Land and Environment Court, it suits you to have uncertain rules, whereas other people who may not otherwise be able to compete with you because they don't have the balance sheet strength, they don't know what the rules are because it's uncertain until you go to court. It may well be that you could, it may well be that what would be more efficient, and as I said, it would be useful to avoid general inefficiencies in the planning system. I'm not saying that the planning system is perfect. The entire message that we've been saying is that would help, but it's not a panacea. Like, that's the one thing version of our submission.
So I have to very strongly argue with you on that point. The evidence before this committee from builders is incontrovertible on this point, that planning regulations in New South Wales particularly, but all the states, Queensland included, Victoria as well, have become more restrictive over the last decade and a half. In fact, we have evidence to your point that builders are going directly to the Land and Environment Court because they cannot sustain the time and effort it takes for local government in New South Wales to continuously change their rulings on different developments. That will have to be my last question because I understand you have a flight to catch.
Yeah, look, that doesn't correspond with my understanding, but I am not a planning expert, and my impression had been that there has been some liberalisation at the state level, and also my
well, I need to disavow you of your impression.
Yeah, the majority of we can come back to you on our assessment of the apartment supply, because we did do some work on apartment supply for the submission, but again, it's not my impression that most, a majority of the apartments that were built were Green Square. There is actually been a lot of infill development right through the middle ring of Sydney as well, in a way that you didn't see in Melbourne and Brisbane. In Melbourne and Brisbane, the apartment boom was primarily in the very inner areas.
Yes.
And again, that was, and
but that's
quite
consistent.
Frankly, you can't build apartments in large parts of Melbourne. It's all in the very inner bit.
Yeah. But that is consistent. But that is consistent with your research. being the Reserve Bank's research, that shows that people have found it incredibly difficult to build apartments close to the city, which has been the driver of price increases. Because there's also the moving dynamic chain study from Finland that shows that if you restrict supply close to the city, it has knock-on effects, mostly felt by low-income people seeking housing. And the reverse was true as well. I'm happy to supply that study to you.
Yeah.
Yeah.
I was aware that you were interested in that study, and I did feel a bit nostalgic looking into some of the filtering models, because I haven't, it's been a while since I went back to that literature for the first time in a long time. Filtering, I mean, the filtering models are, they have some validity there. You can find some papers that show it works, and you can find, other papers from Canada, for example, which I think is probably more, sort of more, more relevant to the Australian environment, that shows that it doesn't. And I think, it really depends on the urban form that you've got. The original US literature on filtering had the presupposition that the rich people were building out on the urban fringe and building big houses, and that the poor people were living in the inner city downtown. And of course, that's not how it works in Australia and in most other countries. And, again, that's an artifact of their tax system and their land tax system.
I don't think that's what that study showed. But Dr. Ellis, I really don't want to be accused of having made you miss your flight. And no, I was about to say something very controversial about Melbourne, which I will avoid. Can I thank you for your evidence today? Was there anything else you'd like to say before I wind up?
Thanks. We've made so many submissions over the years. I think that there's probably enough to chew on there, and our opening statement. So thank you for having us back.
Thank you, Dr. Ellis, and thank you, Dr. Jones. I really appreciate it. If you've been asked to provide any additional information, could you please forward it by the 29th of November? You will be sent a copy of the transcript to make corrections to any errors that you have found in there. Thank you very much. Please go and catch your flight. I don't want to be accused of making anyone miss their flights. I'd like to thank members and witnesses for their time today and declare this public hearing closed. Thank you very much. Thank you, Kate. Thank you, Claire. Thank you, Julie.
Thanks, Dr. Ellis.